So we're going to go through the monthly results. We've got PIMCO coming in for our quarterly economic overview, so I'm going to be pretty brief on my thoughts of the economy. So we have GMO in our continuing asset allocation education program. Martin's going to discuss opportunistic fixed income, and then I'll review the corpus funding plan. So with that, does everybody have one of these in color?
Yes.
Robin?
Madam Chair, before we get started, is counsel from the law department here? Are they coming today?
They know the meeting, so they should be here.
When they do come, I request that we have an attorney-client privilege session and that we recess the meeting. So I'll work with, oh. Voila.
Okay, we're going to go into attorney-client privilege, so could I ask non-trustees to kindly return and leave the room?
If I can clarify, Madam Chair, this is also when we'll ask the advice and opinion of an attorney as a member of the board.
She said she's gonna come right back.
Maybe.
Go ahead.
Ready?
Yep.
Okay, let's go through the monthly results.
No, she's, well, we don't need.
We need a
reporter.
We need a reporter.
We need a reporter.
We need a reporter.
Okay. Oh,
So-
I thought we were playing with Jack.
No, I know.
Yeah, both sides.
It won't be on anybody, it's just.
Audio and video.
Yes, okay. Does everyone have theirs, monthly report?
Yeah.
Okay. Timco's gonna come by, so I'll go quickly through the economy. There, go drive the mic, I'll go through the economy. So page 2 is the GDP. What you probably should be hearing is that because of increased oil prices, inflation and GDP for the rest of the year is the forecasts are slowly coming down. You can see on page 3, on the other hand, capacity utilization in plants is going up. That's a good sign. The manufacturing index on page 4 is going up. Both of those things going up means unemployment claims go down, which is good. And on page 6, the unemployment rate is now 8.8% and also going down. Consumer sentiment, it sort of went down in March, and again, it's some combination of what is going on in the Middle East, increasing energy prices and increasing food prices. The good news on page 8, however, is corporate America is starting to spend money again. Remember, architectural billings are a leading indicator of future construction. Page 9, existing home sales are lumpy. The bigger problem, and again, the bigger problem is foreclosures, which leads to page 10, which is there's no need to build a new home. There's a lot of inventory of foreclosed properties. And that's the biggest problem of the economy. Retail sales, I have no idea why it spiked up on that one day. Let's just assume it's growing around 3.5%. You can see on page 12, auto sales are going up, which is good. They're partly going up because the debt financing for auto loans is back to 0% financing. Page 13, leading economic indicators all pointing up. Again, the trend is going in the right direction. It's just a question of what's the speed, how broad is it. The CPI on page 14, again, because of oil and food is going up. The Fed's less worried about it because they look at core inflation than a variety of people who look at nominal inflation, which again has the food and the oil price in it, gasoline. So for instance, it will ripple back and slow the economy down. That gets us to the markets. And again, this is through, well, some of these charts are through last week. Because in Euroland they raised interest rates. We've got very low interest rates, so the euro is going up, and consequently the dollar is going down. If you look on page 17, you can see against the basket of currencies, we're totally heading south. That's what the Fed wants, because the cheaper dollar helps exports and again, manufacturing. LIBOR is pretty flat. Volatility has kind of gone out of the markets. People are pretty calm despite all the risk that's out there, which we'll get to in a moment. The yield curve has come in a little bit on page 20. Again, the current yield curve is the white line. The good news is that the long rates are again below 5%. And if you look on page 21, you can see the 10-year rate is now 3.35. So I This is what the Fed wants. The big question, of course, is QE2 is going to end in June. Then what happens? In the meantime, on page 22, spreads over Treasuries tighten because people are desperate to find return, and they continue to tighten, although people have one eye focused on when they are going to rise. Page 23 are the PE multiples forward and current of the three major indices, the Russell, IFA, and emerging markets. In general, they're all not very high, which is why people are pouring into stocks. Page 24 shows you the relatives of the mid-cap, large cap, and small cap. Again, not very high. Consequently, on page 25, you see that the markets are going up again. You can see they dipped in March because of the tsunami in Japan, as well as the beginnings of turmoils in the Middle East, but because people have gotten comfortable with the risks, the markets are again moving back up. The red being emerging markets, which has gone up in months. On page 26, you can see M&A activity is trending upward. That's again corporations and CEOs are feeling better about the economy. They have huge amounts of cash on their balance sheet. They're starting to spend it. That's also good for the stock market. That gets us on page 27 to NYCERS market value. We're about $41 billion now, a couple of $1 billion off the peak. On the other hand, remember that NYCERS takes out $2 billion a year. So the real, more relevant number is probably on page 28, which is in the last 12 months, we've gone from about 36.7 billion to about 41 billion, so we're up quite nicely. Page 29 shows you the asset allocation, where we are. I would point out to you a couple of numbers. Generally, we're reasonably well balanced. We're a little underweighted in core fixed income at 14.8%, so it's below the band. However, we have cash of 2.1% because in March, and even though these are February, somehow the cash number is the right number. In March, we decided to take some profits off the table. We made 20%, as I'll show you in a second, fiscal year to date. And we just got anxious about all the risks that are out there that somehow are not being, or basically being ignored by all the markets. So we sold Russell 3000 equities, put it in cash. So the other cash back to the core fixed income, you'll be back in balance. You can see it a little easier on page 30. Which is our dashboard. I think we feel pretty good about where everything is right about now. Again, a little over in public equities will rebalance that. We're underweighted in things that look like fixed income, because there's not a lot going on there. And we're pretty balanced in the equities. We're about 70-30 now, which is where we're supposed to be. If you look on page 31, in February, we made about 2.25% in the fund. The bulk of that in the red and the yellow, which are domestic and IFA equities. If you look over the fiscal year to date, we're up 20%, which is why we thought we'd take a little profit off the table. And the good news, if you look at the far right, we're up 3.4% for the 3 years, which includes the dip in 08. So we made back everything in 08, and we're back off to the races. Page 32, again, if you look at the far left column, you can see all the markets were up, which is why we made 2.5% in that month. But looking forward, because these are all February numbers, on to the next page, which is March, despite all the volatility with the tsunami, the earthquake in Japan, and political unrest in North Africa and the Middle East, the markets basically are flat. So if I look forward to where were we at the end of March, we're basically where we are now. I mean, where we are at the end of February, so up and down, but we're kind of in the same spot. All of which I would say is good. We don't have a lot of comments on individual managers this month, although I would have you go to page 84 in the book. Which is the Tux ranking. So, maybe I'll get there. 84? Yeah. So if you look at the quarter ending in December, remember this is the ranking of funds bigger than 10 billion, public funds bigger than 10 billion. If you look at the first column on the left, our ranking is the 15th percentile, so we're in the top quarter for the last quarter. And if you run your eye to the 1, 2, 3, 4, 5, 6 column, for the year ending, we're in the 27th percentile, so we're kind of knocking on the door of the top quartile, all of which is very good progress. With that, that ends the review of the month, unless anyone has any specific questions. Did you want to say something about equities? Seema would like to say something.
If you could turn to page 36 and 37, I just wanted to remind you, might remember that we talked about a reallocation of U.S. equities, where we moved money out of the Russell 3000 and we shifted money into the mid-cap index to get more balanced and focus on the fact that historically over the last 20 plus years that the mid-cap index had outperformed the large cap index, and so we wanted to capture that excess return. And so if you look on page 36 and 37, you'll notice that in the month of February, the Russell 3000 at the top of the page 36 was up 3.64%. And if you look at page 37, toward the top, the S&P 400 mid-cap index was up 4.65%. So 100 basis points in excess and keeping up with the trend that we had recognized through history and what we're trying to capture here. So that's working well so far. And just to give you a sense, year to date, the Russell 3000 is up 6.7%. The S&P mid-cap index is up 9.6%. And the Russell 2000 is up 7.7%. So again, that relationship is working out so far. If you then just turn to page 40, you'll see at the top of the page, the emerging markets series of managers there. So the BlackRock EM, which is the top one, that we're going to reclassify as passive. That's your passive index that we put some money into as we wanted to get more exposure to emerging markets. So that $535.8 million right there. The performance will show up next month because we bought a piece in February and we bought another piece in March. And so just so you know, year to date, the MSCI Emerging Markets Index is up 4.7%, and NYCERS did better than that because we actually bought on the dip in February and then continued to buy some in March. So we've actually done better than that, and that'll show up next month.
So, is it possible to get just like an asterisk in this report and what the custom bench is, just as a reminder?
Sure. And that's it.
All right, you want equal time or no?
Next one.
Next month? Okay.
Double time.
Any other questions on the performance? Everything's good? We should end the fiscal year right now. Okay. If no one has any questions, we'll bring the economist from PIMCO then.
Someone can take us. you.
Well, good morning and welcome. Liz, if you would introduce yourselves and go from there.
Good morning, everybody, and thank you, as always, for the opportunity to speak with you this morning. I'm Liz Phillip, and together with my colleague, Alan Eisenberg, we have been working with the New York City relationship, which is a very long-standing one for our firm, for probably the last 2 years. But on behalf of PIMCO, we want to thank you for the long-standing relationship that we've had. Next to me is Curtis Mewborn, who is the head of our portfolio management team in New York. And in addition to Curtis's oversight for that team and management of the group, he is also the portfolio manager for several of our mutual funds and multi-asset strategies, including diversified income, which is a global credit strategy, as well as being the portfolio manager for several of our emerging and global multi-asset strategies. Just a reminder in terms of our outlook and forecasting process at PIMCO, as I have told many of you in the past, we purposely at PIMCO do not have a chief economist. We forecast and develop our views in a consensus fashion that involves the input of all of our investment professionals from around the globe. It's done this way by design. That way we burden share when the forecast is maybe not quite accurate, and at the same time celebrate when it is. So our process is such that, again, it's the collective ideas and input from investment professionals from our 11 offices around the globe. As we develop that process and our outlook, both on a cyclical basis and then as we formulate our longer term view, what we do is we take stock of, importantly, where we've been, as well as the current situation, and then look at the analysis and, importantly, ask the right questions on where we think we're going. So in terms of the structure of today's presentation, we're going to start with the idea of where we've been and sort of the current state of things. And Curtis will start there. Alan will pick up with our outlook for the cyclical environment, what we define as the next 3 to 4 quarters, and then I'll talk very briefly about our longer term view, which we will be updating in the next few weeks or so. As always, this is your meeting, and we'd like to keep it interactive, so please feel free to interrupt us along the way and ask questions. With that, I'll turn things over to Curtis.
Okay, well, thank you, Liz, and thank you for having us here today. It is a large topic to try and, in 45 minutes or so, cover the global economy, the current situation, the outlook, the financial market implications. So pardon us, we're going to try and hit on what we think are the key themes. As Liz said, feel free to ask questions as we go, or feel free to steer us if you want more depth in a certain area. We are happy to provide that. So let me just start. We've prepared some presentation materials for you. The first page is the page number 3. And really the key theme we want to leave you with today in terms of the global economy is that we have at least a twin track recovery going on. We have what we think of as a multi-speed world. It's a multi-speed world in terms of growth. It's a multi-speed world in terms of inflation. It's a multi-speed world in terms of how different countries and different policy makers are reacting. And it's a multi-speed world in terms of how investments will behave. So most of everything else on slide 3 you're familiar with. You know, we went through a synchronized global financial crisis, really the first time in probably in 50 or 75 years that we had such a global synchronization. The point is that we're coming out of it and we're no longer synchronized. So let's drill down into that a little bit more on page 4. it's really the emerging market economies that are leading global growth. And this slide 4 tries to hit on a few different areas where you can see the divergence is starting to grow. So the employment picture, the advanced economies, much sharper negative impact on employment in the financial crisis, a much more muted recovery if you compare that to the yellow line for the emerging, a stronger employment picture. Industrial production, the chart on the top right, the emerging economies were the first to come out of the financial crisis, which is what you see here. That's atypical and not what many had expected going in. Retail sales at the bottom is a good preview of what I'm going to show on the next slide, which is the bigger picture. But retail sales, really a tale of two completely different stories here. If you look at the advanced economies, sales over the last couple of years bouncing above 0 and heading back down to no more than 5% growth. The emerging economies sort of averaging 15% growth in sales, so just a completely different picture. And turning to slide 5, if you summarize all that data in terms of GDP, so the measure of the total economic output, on the left-hand side of this chart, we've shown the developed economies. On the right-hand side, we've shown the emerging economies. And you can see the sharp distinction here. So, what looks to be 1 or 2% inflation-adjusted growth, so that's after taking out inflation, 1 or 2% for the developed world versus 7 or 8% for the emerging world. So that alone is a really stark difference. That's something we haven't seen historically, and it's something that matters more and more today, more and more for the future, because in the past, even if I'd shown you this graph, you could have said, okay, that's true, but the emerging economies just aren't big enough to make a difference. So even if they're growing faster, really what matters is the left-hand side of this graph. Well, the second largest economy in the world is on the right-hand side of this graph, and within the next 10 or 15 years, at least half of the largest economies in the world are the ones that are on the right-hand side of this graph. So one big change is that at these faster growth rates, the emerging economies have become big enough to matter. Bottom of the chart shows inflation. Similar picture here. Inflation running on average 2, maybe 2.5% across the developed economies versus a much higher inflation rate that we're seeing in the emerging economies, 5, 6, 7%. So when I talked before about a multi-speed world, you're seeing multi-speed here in growth, you're seeing multi-speed here in terms of inflation. And when you put those two together, which is the way that most of us think, how fast is an economy growing in nominal terms? It's growing at the inflation rate plus the after-inflation growth rate. You have emerging economies, broadly speaking, growing at 13, 14, 15%. That's a really high number. You have developed economies growing at 3, 4, maybe hopefully 5%. So you have a 10% difference in terms of the growth rates. And to us, if there's one thing that investors have to think about and get right, it's that in a multi-speed world like that, there are very important different investment implications, depending on which part of the globe you're operating in, depending on what the demand is for different factors of production in each of those areas. So we can come back to those themes in a minute, but that's really at the high level how we see the world. Now, interestingly, if you go to the next several slides, I'm going to show a bit of a disconnect from that. So if you then flash to financial markets are telling you a little bit of a different story. They're telling you that most of the major economies are sort of operating in a more synchronized fashion. So you're seeing less of the multi-speed story here and more of the single-speed story, whether you look at interest rates, which are shown in the top left, whether you're looking at credit spreads or borrowing costs in the bottom left, or whether you're looking at even equity market returns, although within equity market returns you're starting to see a little bit more of the divergence in the multi-speed nature. I would be remiss if I didn't spend some time talking about, on page 7, a really important factor that is related to this multi-speed world, and that is what's going on in what was formerly thought to be the developed, part of the developed economies, namely the peripheral countries in Europe. And by these countries, we're thinking of countries like Portugal, Ireland, Greece, Spain, perhaps, and then there's a continuum as you go after Spain to Italy, and then more towards the core countries, France, Germany, etc. And what we're seeing in the peripheral countries is also somewhat unprecedented. So for the first time, certainly in recent memory, the last 50 years, we're seeing countries need to be rescued. We've seen large rescue packages put together by the European Union and the IMF for Greece, for Ireland, and now we've seen Portugal request one. And in all cases, these are 100 billion euro type loans from the European Union and the IMF to these countries. These loans come with conditions that the countries are going to need to tighten their belts in terms of cutting back on their spending, reducing their budget deficits. And we're already seeing, therefore, a slowdown in growth in those areas. So if we look at GDP growth in places like Greece, it's currently -7%, so that economy is still shrinking. If you look at Ireland, -1%, so that economy is shrinking. So the problems that are going on in these countries and the pressures that have caused them to ask for very, very large loans from these international lending agencies are very much ongoing, and on a forward-looking basis, to us, add to this multi-speed world, because they will certainly slow down the growth in these countries. And really, I should mention two other key points, I think, before we leave this page. We've shown the spreads here in this chart. It's not the most beautiful chart in the world, but I think that the first of my 2 points I want to make on that is, in many cases, the financial markets or the spreads are at their widest levels right now. This problem isn't behind us. This problem didn't end months ago when the countries asked for these and received, in 2 of the 3 cases, these large loans. These problems are still viewed by the markets as being in front of us. So very much relevant, current, and flashing orange, if you will, on a warning signal.
Yeah, to follow
Please.
up on that, do you have an opinion of whether Spain will join the others? If so, whether or not it takes down the EU and what it means for investment implications in Europe for the next decade?
That's probably the central question that we ask in terms of our European strategy. And in short, our view is that these policies and these lending programs are designed to ring fence the smaller countries. So the idea is, if you can stop the problem with the smaller countries, the contagion won't impact the larger countries. We believe that that strategy will be effective. So we do think that there is the ability to make a fire break between as I mentioned, the small economies in Europe, Greece, Ireland, Portugal, Spain's roughly 3 times the size of any one of those, and that these measures will be effective at containing it. Now, do we have 100% certainty of that? No, certainly not. But we think that is our baseline scenario, is that they'll be able to do that. That will therefore be a picture of slower growth for Europe, dragged down by these countries at the periphery that need to be rescued, but not a second financial crisis for Europe. One of the reasons that these loans have been put together, one of the reasons these countries have agreed to take their own resources and give them to the neighboring countries within the EU, is that there's such a high degree of cross-lending in the banking system. So the banks from one country make loans to the banks in the neighboring country, that it is viewed as highly problematic if you're not able to to limit contagion. So a financial crisis in one area is seen as having a likely high impact on other countries' banking systems and their economies, and that's why you're able to get political consensus to make these large-scale loans. But I guess my last point, I said I wanted to make 2 points on this. My second point on this is if you had to put on a bumper sticker, what is the reason that these countries had to go ask for a loan? It's because they were too indebted. They basically ran budget deficits that were too high, they had too much borrowing, and in the case of Greece, they got to 140% of government debt. measured in terms of their GDP. In Ireland, 100%. In Portugal, 80%. So these are very large numbers. These numbers are much larger than the size of the debt in, say, the Latin American debt crisis. In those cases, 50 or 60% government debt to GDP was thought to be too much debt.
What's the US's?
Yeah, so that's why I mentioned those numbers. It's 80 right now, right? And so the
And does that
US,
include agency debt?
no, it is 80 by the most optimistic of measures. It's not including the size of the agency, the mortgage markets. It doesn't include the off-balance sheet items, you know, the pension benefits, healthcare. So it's arguably a much larger number than 80%. And maybe that's a good segue to the next slide, right? Which is the U.S. is not immune from these concerns, and this is very much a relevant factor for us. Just last week, S&P put the U.S. on negative outlook, and their definition of negative outlook says there's some reasonable chance of a downgrade. I think they say 1 in 3 or something within the next year or two. So that is a chance of the U.S. debt situation causing the credit ratings of the U.S. to go below AAA, and they're really citing their primary reason for that is they don't believe that the current budget situation, that there'll be able to be enough cuts in the budget, enough savings in the budget to stabilize sort of the debt dynamics for the U.S. So this is a very important factor for all of us to keep in mind. The other thing that I wanted to cover on this chart is the Federal Reserve, as shown here on the bottom, has started a second round of quantitative easing last fall. You can see if you look at the last bar where it says December 10th in red, the Federal Reserve purchased about 2/3 of all new Treasury borrowing. So in addition to the situation that the U.S. has been borrowing too much and the rating agencies are worried about it, a second factor that we think is very important for investors is the lending was from the government itself. So the government has basically been loaning itself money through the Federal Reserve, expanding their balance sheet, quantitative easing. We expect that to stop in June. We'll hear more tomorrow when Ben Bernanke has his first press conference post a Federal Reserve meeting. But with that likely to stop, the second problem we would say is not only is the debt too high, but one of the big lenders is going to go away. And so we expect the market reaction to be that there will be consequences of the quantitative easing end. Okay, just a few more points that I want to cover.
So what are the consequences?
I think the consequences, as we would lay them out, are likely higher interest rates in the U.S. and in some of the highly connected interest rate markets around the globe. That we would see an increase in financial market volatility. So part of the quantitative easing program, and Ben Bernanke even laid this out in an op-ed piece, was one of the intentions was to stabilize financial markets. That seems to have been a result. So therefore, if quantitative easing goes away, the chances that there's some destabilization increases. So we would expect at least volatility in financial markets to increase. And we would also expect to some degree to see perhaps a slowdown in U.S. economic activity related to that. So there'll be more difficulty in terms of mortgage financing at higher rates, maybe a slowdown in the construction sector from that. So those would be probably the key implications as we see it.
Right, and that's not taking into consideration whatever deficit reduction program we end up with. Is that correct?
Right, so the current views are that the deficit reduction proposals will be fairly small in terms of solving the overall debt problem, but they certainly will not be stimulative to the economy. They would also go in that same direction in terms of being a drag on economic activity.
But not to the extent that we have a miniature double dip or whatever you'd say.
Yes, so our baseline scenario is not for negative growth, and we'll in 2 or 3 minutes I'll pass it to my colleague, and he'll give you sort of our outlook in the near term. But we do not expect it to go negative, but we do expect it to be a drag. Maybe just I'll just hit these quickly because I've gone on. Page slide 9.
Let me
Sorry.
let me ask you one more question.
Sure.
So the discussion on one side of the political aisle of restructuring Medicaid and Medicare to deal with the deficit. What would your take be on that? A significant restructuring of those programs.
So our expectations are not for a near-term significant restructuring. We think that the most likely outlook will be most likely outcome will be more of a postponing of dealing with that issue, kicking the can down the road, if you will. And it's probably, it's unfortunate because it's probably one of the most important medium-term issues that we need to deal with as a nation. So maybe I'll just stop, one final thought, and then I'll pass it over to my colleague. And slide 9 is as good a slide as any to highlight this. Slide 9 shows central bank policy rates, and you can see that they are at, in the bottom right hand, not just at the lowest levels ever. They've been at those low levels for a couple of years, so more than 2 years in the case of the U.S., where we've had 0% policy rates. These are very much an emergency policy reaction, and I think most would agree we are, while we're not in the rosiest scenario ever, we're in a far better situation than we were during the depths of the financial crisis. So what's quite surprising is that we have still emergency policy measures, 0% interest rates in play, even though the financial crisis was stabilized. And to us, we expect to continue to see, especially in the case of the U.S., low policy rates. So we think that in some sense this high debt stock almost requires that the central banks keep rates very low in order to keep some sort of economic activity going. So at the very near term, so over the next year, we do not expect to see, over the course of 2011, we do not expect rate hikes from the U.S. Federal Reserve. And what that means in terms of investment implications is that at least some of the interest rates out there, the government-controlled interest rates, we do expect to stay anchored by these very, very low policy rates at the front end. Now, without getting too into the details, you can create a scenario, and it's what we expect to happen, where the markets will price in longer-term inflationary fears. So think 30-year bonds or 10-year bonds will have higher rates, while, say, 1-year and 2-year bonds will be anchored by these very, very low rates. And that, in a nutshell, is sort of what we expect to happen. So why don't I stop there, and we can shift over and go to sort of our forward outlook.
Absolutely. Thank you, Curtis. And thank you all again for your confidence in PIMCO and for inviting us here to speak with you. Let's take a look at page 14, if we could. And so recently, a fair amount of discussion has emerged about whether the U.S. economy has achieved exit velocity, if you will. You hear stories regarding corporations putting cash back on their balance sheet, banks to some small degree beginning to lend again. And while we recognize those trends and view them as very much positive, we don't believe at PIMCO that the 2011 growth will be sufficient to achieve that escape velocity, if you will, from the sort of dragging economic recovery. A few reasons for that. First of all, the markets are already pricing in the growth that was driven by the stimulus. And that growth, as we know, is largely synthetic in the sense that it came from government mandates as opposed to sort of bottom-up demand. The U.S. state and local governments are confronting severe budget situations. Many public pension plans have funding issues, as well as taxpayer reluctance to make up the difference. European austerity, while helpful to some degree in averting a wider spread liquidity crisis on the continent, is causing muted growth there. And as we think about the high increasing power of the euro at this point, that will also damage European exports, because of course the stronger the euro, the less Europe is able to sell its goods overseas. The stronger emerging market balance sheets are powering robust emerging market growth. Then the question has to be asked, if you see strong emerging market growth, which is imported by the developed world, are we also then, to some degree, importing inflation from those economies as their currencies appreciate? Further to that, oil and commodity inflation pressure is applying some degree of pressure to corporate profits and consumption. I'll touch on that later. And then, of course, the geopolitical events, whether it's the earthquake in Japan or the tensions in the Middle East, are further contributing to uncertainty. So if you look on the next page at our, what we call our cyclical forecasts, which is to say our 6 to 12 month view of the economy. In the United States, we foresee continued reasonable growth numbers in the 3 to 3.5% range, with some modestly increasing inflation in the 2 to 3% range. Europe is a bit more muted, where we're looking at essentially growth and inflation that are each about half of what we would predict for the US. The same goes for the United Kingdom. The Japan situation is, of course, more negative and probably even more so than this page would indicate in light of the earthquake, which damage of which is estimated to cost as much as $350 billion, be the costliest natural disaster in history. So we're looking there at likely negative growth and extremely muted inflation, if not perhaps even deflation. China and what we would call the BRIM countries, Brazil, Russia, India, and Mexico, much rosier pictures on the growth front with 4 or so % growth. Currently in China, with estimations of that rising another 100 basis points or so. And then inflation, 8% growth, pardon me, in China, with inflation in the 4 to 5% range. And then in Brazil, we're looking at 5 to 6% growth with inflation in the 7 to 8% range. And in that situation, you do have somewhat of an overheating risk, but the government is taking steps to try and address that. Formerly with President Lula and now with Dilma Rousseff, his successor, are trying to take some steps, whether it's constraining the appreciation of the currency or other steps they're taking to try and keep that under wraps. When we look at sort of the difference, and we're looking now at page 16, between the growth in the United States and in Europe, what we're seeing essentially is that the real difference here is simply the policy approach that was taken by each of the respective governments. The crisis affected both countries very similarly, but what we saw in the US was aggressive stimulus, whereas what you saw in the UK and in continental Europe was a much more restrained, austerity-focused approach. And as a result of that, you can see on the chart in the top right-hand corner the stimulus impact essentially taking US growth to where it is, especially by virtue of the tax compromise that the government reached in December, as well as quantitative easing and other stimulative measures. You're seeing that having a positive impact on growth, whereas in Europe, that's far more muted. So the United States real GDP, as a result of these easing measures, as a result of corporations beginning to fund their balance sheets and investing as they are and rebuilding their inventories, you're now seeing US real GDP above pre-crisis levels. In contrast to, if you look at the chart on the lower right, the UK and EU are both potentially years away from returning to that level. That said, in the United States, the reason that we are not necessarily optimistic about achieving a full escape velocity is structural headwinds that remain, and those are threefold in our view. The first is unemployment, right? So unemployment, the numbers have gotten marginally better in the last year or so, but you still have to consider what we would refer to as U6, the number, which includes not only people who are unemployed, but also people who are underemployed, people who don't have the level of employment that they would optimally like to pursue. And so we do still see multi-decade highs in both unemployment and underemployment. We expect it to persist. Secondly, housing, in terms of both demand for new housing and housing prices, have both been on a fairly strong downward trajectory, and we've not seen a meaningful turnaround in that regard. And then finally, deleveraging. Of course, it used to be a concern that the US consumer spent too much money. Now the question emerges, are we saving too much money, in the sense that limited willingness to consume goods could impede growth going forward. We would view, of course, the decision to save more as contributing to the overall health of the economy, unless taken to an extreme, in which case it can actually limit consumption, which has historically been the primary driving force in US GDP. And finally, when we do talk about prices, The one trend that will segue into what Liz will discuss in terms of our secular 3 to 5 year outlook is that the vast inflation that we're seeing in commodities is not yet feeding into final goods and services. So if you look at the price of gold at $1,500 an ounce or oil at $112 a barrel, that's a situation where the final goods and services aren't yet pricing those in. So what happens in that regard is you see the price inflation, but it's not yet feeding through, and so what happens thus is that we would expect it down the road to feed through increasingly. So while the consumer might be suffering at the gas pump right now, the companies who are bearing the burden of higher oil costs or higher raw materials costs have not yet passed that on to the consumer. We would thus expect that when that does ultimately happen down the road, that the implications for inflation would be significant. So with that, I will turn over to Liz, who will take us into our longer term outlook.
And I'm going to just spend the last couple of minutes talking about our longer term outlook. I promise that we won't go through this page by page. In fact, I'm going to draw your attention to page 21, and just continuing on the theme that Curtis outlined in terms of this multi-speed world. Just remind you of what our secular or longer term view, 3 to 5 years, is what we define as the secular time frame. And to caveat this just a bit, as I mentioned at the outset, we will be revisiting this outlook in the next couple of weeks or so. So, view this as a little bit of a work in progress, but yet the themes that have been in place and that we confirmed at our last secular forum remain in place, and that is the journey to what we have dubbed the new normal, and some key themes that are part of that. This idea of differentiated growth, strength in the emerging economies, the developed nations facing a mountain of debt, and that causing really this tension and this divergence in growth versus where we were previously of a strong tide really lifting all boats and leading to very positive outcomes, both by way of growth and by way of asset class returns, as we'll talk about in just a moment. With high debt levels, increase in fiscal debt, the consumer continuing to be hamstrung, there's really this lack of another spare tire in the economy, this lack of additional stimulus that can be pumped into the economy to either prevent what you had talked about in terms of a double-dip recession, which again is not our forecast, but again, the ability for policymakers to really continue to stimulate the economy is somewhat mitigated by the fact that so much stimulus has already occurred, both in the U.S. and developed nations alike. And then there is, of course, as a result of that, this competing tug of war between disinflation, even deflation, and inflation going forward, as we have to, at some point, stop kicking the can down the road and deal with the deficit issue as it stands. I'm going to just kind of backtrack just a second as we look at that differentiated growth and focus on debt, again, more specifically. And again, this will be, I believe, part of our many topics that we'll discuss in a number of weeks, as well as the political landscape and the political tension surrounding it. But if you look at things from a stock perspective and initial conditions, if you look on page 19, a picture is worth 1,000 words in terms of debt as a percentage of GDP. Drawing the chart right down the middle, on the right-hand side, the emerging economies, on the left-hand side, of course, the developed economies, and the level of debt, all things considered, that is actually much higher when you go beyond just government debt. You see from an initial conditions perspective that the emerging economies are in much better shape than the developed economies as things stand. Now, couple that with the idea of poor demographics in the developed world, and the consumption ability in the developed world becomes hamstrung. Moving to the emerging markets on page 20, the concern around emerging markets that while the demographics were better than the developed world, the capital markets and the ability to spend was muted, and we're seeing that change. We're seeing a pretty substantial growth in the middle class, which has the highest marginal propensity to spend, and hence where this idea of a multi-speed world and all eyes turning to the emerging markets is the growth engine going forward. Moving then on to page 23, as we look at the journey to the new normal and define what we mean by the new normal, this multi-year process of deleveraging that's already occurred in the private sector, but still has a way to go, certainly will have to turn to the public sector as well. Desynchronization by way of growth, again, the emerging markets picking up the baton and the shift turning away from the developed world to the emerging markets for growth going forward. Couple that with then the backdrop, or really the other element there, and that's re-regulation. Given the crisis and the desire to prevent further crises, the idea of re-regulating the economy will have impact by way of productivity and growth going forward. Looking at page 24, a multi-speed world has implications on the investment side as well. And as I mentioned, in an economy where growth is strong around the globe, in the developed world, where consumers are consuming, have the ability to lever balance sheets, and investments really across the board benefit, you see that the distribution of outcomes in the old normal is a lot more confined than what we anticipate them to be in the new normal going forward, given increased volatility, given all of the risk factors that we have outlined already, and the uncertainty as we try to achieve both escape velocity in this country, but provide global aggregate demand going forward. We think the investment outcomes will be a little more dispersed than they have been in the past. Now, all is not lost from an investment perspective. Just moving forward to page 25 and pages 25 and 26. The new normal scenario and the prescription for investments going forward is just to not take the status quo really as law. And as you look to achieve return targets, 7, 7.5%, 8% return targets, the idea of allocating toward investments of the past and relying on a reversion to the mean, we think is what needs to be considered. Again, the new normal outlined and characterized by continued deleveraging, re-regulation, and this tug of war between inflation and deflation, inflation and deflation going forward. Moving forward, and I'll end here on page 26, the investment framework then that this leads to is one that analyzes, instead of just allocating among asset classes, it requires that you look at the risk factors that are embedded in asset allocation and be forward-looking in your framework. Again, not relying on asset returns of the past, an economy of the past, but instead looking at the world more on a forward-looking basis. Again, including more of a global focus, looking at which risk factors are worth allocating to, increasing or decreasing, and then importantly, remembering that if investment outcomes are going to be more dispersed, hedging the tails, or those things that may have low probability but high impact if they occur, by way of inflation, by way of policy mistakes, and by other systemic shocks to the system. So again, continuing the discussion that you have been having, but again, looking and moving your asset allocation decisions more to a forward-looking basis versus relying on the past. We have been talking for quite some time. I'll stop there and answer any remaining questions that you may have.
So what do you think the top 3 risks are in the next 12 months?
Yeah, I think there's a couple. I think there's a risk of a policy mistake as global central banks try and come away from these emergency 0% interest rates and quantitative easing, shrink their balance sheets. So that can happen too fast. That can be a policy mistake that feeds into financial markets. I think inflation is a very big risk out there. Inflation is being driven by at least two factors. You could argue part of it is quantitative easing and lower interest rates are driving up the prices of assets, but you could also argue the two-speed world is driving up the prices of the inputs into production. And so even if the quantitative easing and the low policy rates goes away, the other factor may be a larger factor, that is the growth in China, Brazil, India, et cetera. So that could drive inflation up to a very high level. Bring it all back home at $5 a gallon at the gas pump. That really starts to slow down other consumption in the U.S. and really starts to impact things. And then I think the third risk that I would put out there is the biggest risk is the global debt stocks a unorderly unwind of that. So you can put under that category the rescue packages aren't big enough for the countries that need them in Europe, and they may need bigger ones. You can put under that category, we're recently getting some information out of Ireland that while initially all bank debt was viewed as being protected and covered by these bailouts, now many of the constituencies want more burden sharing. Some of the equity investors should take a loss. Some of the debt investors should take a loss. So as you get these restructurings come into play, they could be disorderly. Our laws, do they lead to litigation? Do they lead to winners and losers in a way that destabilizes the globe? I would say certainly that the debt problem is large enough and it's wide enough that is going to be something we deal with, all of us, for the next 5, 10, 15 years. So that's something I think we need to all get more comfortable with thinking about and understanding. And I think for the investment implications of that last one, it also means we need to be savvy about making sure we take into consideration those risks when we make investments, because unintended actions from debt restructurings, and I think everyone around the table would agree there's a very high stock of debt, so there will be restructurings. I think we'd have a very long debate about which country and which company and how it would play out, so there's not certainty there. And so investments, therefore, you need to be very careful to make sure that you're not negatively impacted if those restructurings turn out to be disorderly.
Curtis, living in the country with the world's reserve currency, do you think we're too complacent about how much wealth we have and resources are being competed for so significantly by other countries that are, from a currency perspective, being far wealthier?
Very much so. So I think there's a few really important factors that are going on there. One is when we think and talk about a PIMCO, the global reserve currency, we recognize that on a much higher frequency basis, there are serious attempts to change the nature of that. So China, for example, it continues to open up their currency. They first allowed more offshore banks in Hong Kong to exchange the currency. Now they're allowing companies like McDonald's to issue debt, issue bonds denominated in their currency. And each and every quarter, there are more and more announcements by China to make their currency more freely convertible. That becomes an alternative. Is an alternative, within the next year to the U.S.'s global reserve currency? No. Is it a viable alternative within the next 10 years? Maybe. So you're seeing challenges there. You've seen certainly the euro take on more of a medium of exchange status. So, I think the PIMCO view wouldn't be overstating it to say that we see the role of the U.S. dollar as reserve currency waning. That is, in importance, it's going down. We can have a debate about when it goes away and what replaces it, but it's on the descent. In terms of the second part of your question, which is the growth rates in other parts of the country, other parts of the globe, I think it's very, very important for us as a nation and us as investors, and given our fiscal our fiduciary responsibility, rather, to recognize that other countries have a huge productivity advantage right now in terms of taking all the technology and know-how that's been developed in the West for the last 25 or 50 years and applying that to lower labor forces, and that'll result in higher productivity, and that'll result in higher valuations for their financial assets, their currencies, etc. So if you share that belief that we're overly complacent here, and I certainly do, and I think it would be fair to say we do at PIMCO, And if you share that belief that the likely consequence is an increase in valuations away from the US, and if not a decrease, at least sort of a status quo here while the other goes up, then thinking about that from an investment perspective is very, very important. How do you protect your assets by making sure they're not in the depreciating area and making sure they're benefiting from this generalized increase?
I think as Curtis mentioned, the idea of who we pass, or who the baton gets passed to by way of a reserve currency is the question. But in terms of direction of the dollar, depreciation and continued depreciation on a secular basis is really the theme.
And is one way to make money from that theme emerging market debt to now making local currency?
Yes, so for the near term, we think that's a pretty good way to take advantage of it for two reasons. One, the higher inflation rates that we talked about in here in those countries mean that they have higher interest rates. So whether you're talking about short-term treasury bills or whether you're talking about long-term 10-year bonds, the interest rates in those countries, maybe you can use Brazil as an extreme example. In Brazil, you have 12% interest rates versus the US 2% interest rates for similar maturities front end of the yield curve. And usually, historically, those higher interest rates have been, at least in part, to compensate from a expected depreciation of the currency because of inflation. So while you got paid more up front, the value of the currency went down later, and the economic theory or the academic theory is it all sort of evens out. Our view for the near term, like the next, say, 5 years, is that we're in an atypical period where you will see a decrease in the dollar and an increase, generally speaking, in emerging market currency valuations. So you can actually get both the high interest rates and a currency appreciation. And effectively, that's related to what we were just talking about before, which is the productivity and the growth increase that's going on. It's sort of a one-time effect. That can't happen forever, but you can have a one-time shift. And so we think near term, a very good way to do that is local market emerging currency. You can either do it in the short maturity treasury bills, if you think that inflation is going to stay high and it'll cause rates to go up for the near term, or you can do it in the longer maturity if you think those rates already price in enough expectations of higher rates. And we actually are in the latter camp now. We actually think the long maturity bonds more than compensate you for expected inflation.
If you look quickly on page 15, you can see specifically with reference to the BRIM countries, right, Brazil, Russia, India, and Mexico, you have real GDP growth anticipated of 5.5% to 6%. So those high real rates, you would believe, would cause the currency to appreciate. But then the inflation forecast is so high that you would expect, right, as Curtis was mentioning, in most situations, you would expect that to hurt the currency. But Brazil is having trouble controlling its currency based on how fast it's shooting up. So the interesting part of it, as Curtis pointed out, is that forces of growth are so strong that the currency is appreciating in spite of whatever inflation concerns may exist.
And what are the risks of investing in China and Brazil?
So there are many. The traditional gamut of risks that one would think of would include political risks. It would include capital control, so the inability to move money freely in and out. Those countries historically have also been very vulnerable to global financial market disruptions because capital flows in those countries reacting quickly. We would argue that the future will look a little different than the past, given the slide we showed about lower debt now for those countries and higher debt for the other countries. In the past, it was reversed, so they were the more vulnerable and therefore, as you would expect, had more negative reactions in a crisis. Now they're less vulnerable, so we would argue they will be less susceptible to a crisis. But those would be the main ones that we would highlight. And of course, there's also some subtle secondary effects when you're in a multi-speed world. So if the countries are generally growing at the same rates, then the chances of one country significantly impacting another are more muted. in the current situation where you have such different growth rates, 15 versus 1 or 2 in the case of say Japan, a slight slowdown in one area can have a really big impact on, say, the demand for machinery out of Japan, or the demand for raw materials out of Japan. Sorry, not raw materials, the demand for components that go into assembled products, say in China, out of Japan. And so it's sort of a secondary effect, but the multi-speed world means that another risk, we would say a newer risk that investors have to think about, is how does that volatility impact different sectors, different industries, and what's the most sensible way to deal with that. We would say, therefore, that sort of the global financial system is more dynamic over the next 5 or 10 years than it might have been in the 80s and 90s, and so you need to have more dynamic investments.
So what are you telling your investors in terms of emerging market debt? What are you telling them about investing?
Sure. So the first would be if we had to rank them as we saw the opportunities now, we think the highest degree of certainty we have is that the emerging currencies will appreciate versus the dollar, and the highest real rates, that is just a fancy way of saying rates after you adjust for inflation, so your real purchasing power, the highest real rates that we see in the world are in emerging countries. So when we put those two together, we say our highest probability is local emerging market debt. And I just contrast that really quickly. We had a treasury auction in the US where you got, last week, a 5-year negative real rate. So you actually end up with less spending power at the end of 5 years if you hold these US government bonds. That to us, if one place has positive and one place has negative, you have to have a really strong view about some other factors if you're going to go start out in the negative real rate world. So that would be our highest. Our second would be emerging market corporate debt, dollar denominated, but of companies that are benefiting from this faster growth, right? So you don't get the direct impact from the currency or the higher rate, but you get at least the impact of the companies operating in these faster growing countries. And then the third would be dollar denominated government debt, if we had to sort of rank the emerging market opportunities.
Any
Any
more
further
questions?
questions? Thank you all very much.
Thanks.
Thank you.
I think GMO's outside, they were looking at it. So I think
You want a second break? You think we're good?
yeah, how about
How about a short discussion?
a break? You want a discussion?
Well, later about this topic.
About the economy?
No, I found what they had to say about foreign country debt very interesting.
I think it might be even helpful to hear GMO because they do have a lot of asset allocation comments. That's what the whole presentation is. And so maybe if we can combine those two and then have a discussion, would that make more sense? Gary, do you think that's?
Yeah, you'll be happy to know next month when we get to our asset allocation. There's emerging market debt in it. So we all see the world the same way, I think. To varying degrees. But you want to take a break before GMO?
A short break,
Yes.
7-8 minutes, come
Yes.
back to 11:30.
11:30? Synchronize your watches.
introducing yourselves.
We'll do so, and thank you very much for having us join you today to talk about asset allocation at GMO. My name is Drew Tammany, and I'll talk briefly about the firm. I have to my right Ben Inker, who's the portfolio manager and head of asset allocation at GMO, a very important business to us. And to my left is the CEO of the firm, Mark Mayer. He'll make a few concluding remarks. How much time do we have today?
Half an hour or so?
Half an hour or so, okay. We'll use that efficiently. If you have a question, please do ask it. Did everybody get a book? I brought, I think, enough, but if somebody's missing one, there are a few left here. Over there, okay. Thank you. So I'd ask you to turn to page 2. It's a real quick snapshot of our firm. Founded in 1977 and still a private partnership today. It's very important to our business because with a private partnership, we can do the right thing for our clients. We think in a very thoughtful way and sometimes contrarian, as you'll see as we get into the remarks. But when we're contrarian, we hold on to that thinking and make the right decisions for clients over the long term. The other point on the page is that we're an institutional firm. We only manage for institutions, and many of them are much like yours. So we think in an institutional way. We are looking for clients to join our practice who think in an institutional and long-term way. Our firm is now $109 billion in assets under management, but very important for today's discussion is asset allocation is a very important business for us, one we've been in for a long time, and one that represents 40% of what we do. The map up top shows you where our offices are. We're founded in Boston some 34 years ago. Most of us are still there, but investment centers around the globe so that we can have research done around the globe and know where things are cheap and where things are not cheap and make those right decisions on a regular basis. There's a question about page 2. I'd be glad to field it, but it's a quick snapshot on the firm. And with that, I'd ask Ben Inker to pick up to talk about career risk on page 3.
Okay, so, in thinking about investing, it is a sad truth that you do not get paid unless you're willing to do something that other people don't want to do. When we look at the portfolio that you guys have now, the big risk in your portfolio is equity risk. You've got a lot of equities. And in general, people don't want to hold equities unless they're getting a decent return. Equities are risky. They tend to do badly at inconvenient times, and when they do badly, you can lose a lot of money. You get paid for taking on equity risk. The difficulty is there is a reason why you get paid for taking on equity risk, and if it's a big part of your portfolio, then you are taking a big risk. So it would be lovely to be able to come up with a way to have similar returns to what the expected returns are to your portfolio, but with taking less of that equity risk. The question is, if you're going to do that, how are you going to pull it off? What are you going to give up from a risk perspective? If in return you're going to be able to take less equity risk, take less risk of doing very badly from 2000 to 2002 or 2008, 2009. And one of the things we think you can do is look at what investors really care about that they shouldn't. And so a lot of what we do in asset allocation is trying to understand markets, but as much trying to understand investors and where investors make choices that are not entirely irrational, but might be able to be exploited by people with the right mindset. And a lot of that comes down to this idea of career risk. So what do I mean by that? When we look at the market, there are a lot of forces that tend to push markets away from fair value. Market participants are people. People tend to make certain mistakes over and over again. They tend to extrapolate the recent past into the indefinite future. So whatever's been going on now, they assume it's going to continue going on. If silver's been going up, people pile into the silver ETF. They also take real comfort in being in the herd. If emerging markets have been the hot asset, they want to be in emerging markets so that whenever everybody's talking about it, they don't feel like they're left out. All of these forces can push the market away from fair value. And eventually, markets have to be dragged back. Because at the end of the day, a company shouldn't be worth more than the replacement cost of the assets of that company. If you could rebuild that company for $100 million, it doesn't make sense to pay $200 million in the market for it. But even though that replacement cost is the gravitational pull for the market, it doesn't tell you when the market is going to come back. And that's true both on the downside and the upside. If stocks are really cheap, as they were from the mid-'70s to the mid-'80s, eventually you're going to get a very good return out of it. But it doesn't mean you're going to get a really good return out of it tomorrow. And that timing uncertainty is a crucial part of why we think there's some exploitable inefficiencies here for asset allocation. And that comes down to the problem that institutional investors are not only people, they are professionals. A professional money manager is by definition someone who's managing money that isn't theirs. And the problem when you start managing money for other people is you change your idea of what risk is. Risk is no longer the risk of losing money, it's the risk of losing a mandate. And the one thing that professional investors feel they can't afford to do is look stupid. If you look stupid, if you have bottom quartile performance, if you are missing the big thing going on in the market, you will look stupid, you will get fired. And so people don't want to do it. And the nice thing about that is it provides nice exploitable opportunities for investors who are prepared to be patient, to be contrarian, and to think really hard about what the replacement cost is. It isn't easy, because one of the things that you desperately need, in addition to decent insight and good data, is patient clients. And it is difficult to find a lot of patient clients. So we want to try to exploit these inefficiencies. We want to try to exploit the fact that most people in the investment business are not interested in doing anything that gives them a risk of looking stupid. But if we're going to do that, we need to have a discipline, a framework for how we're going to think about things. And we like to call it the 7 immutable laws of investing. And I'm going to go over them briefly here, and then we're going to get into some examples of how they work and why we think they are important if you have taken the decision that you're willing to look different. You're willing to do something that might make you look stupid for a little while in the hopes of getting a more efficient portfolio, a higher return portfolio for the risk you're taking. The first, and probably the most important, is always insist on a margin of safety. What this really means is value matters tremendously. Stocks are not inherently of a particular risk, nor are bonds. If you are paying a fair price for stocks, you are going to get a decent return for the risk you're paying. If you are paying 35 times earnings, you can't afford for anything badly to go wrong. The nice thing about a margin of safety is if you buy something cheap, you can afford for the world to turn out differently than you were hoping. This time is never different. It is very dangerous when people start talking about why it's okay to pay 35 times earnings this time around. Be patient and wait for the fat pitch. One of the most difficult things for investors, and particularly professional investors, is to have the patience not to do anything. There is this strong action bias. You're coming before your investors and they're saying, well, what did you do this quarter? Well, we kind of sat there and we didn't change our portfolio. Well, why? Weren't you paying attention? It's hard to be patient, but it is essential to be patient. Then be contrarian. One of the nice things that we can exploit about investors is investors are very focused on whatever has been doing well recently. It's what gets on CNBC, it's what gets in the Wall Street Journal. If you can find the stuff that nobody is talking about, that's probably a good sign to begin with. Then, risk is the permanent loss of capital, never a number. What do we mean by that? A lot of people put together very complicated portfolios. They'll give you numbers like the value at risk of the portfolio. This is the amount of money you're likely to lose on a 2 standard deviation event on one day, and you're supposed to be able to make some sense of it. That isn't what risk is. Risk is about losing money that you never get back. And what you want to do is avoid that. One of the real important ways to avoid losing money that you never get back is to be very careful about levering up your portfolio. Leverage is what can turn a temporary loss into a permanent loss. And then finally, never invest in something you don't understand. Why is this important? I mean, you can't understand exactly what your managers are doing. But if you really don't understand what they're doing at the basic level, the problem is, how can you possibly be patient? If they are underperforming and you don't know what they're doing, you have very little choice but to either take it on faith for a while or to get rid of them and hire somebody else. If you're investing in something you don't understand, you won't know what to do when it goes down. So on the margin of safety, this exhibit, page 5, is kind of a fun one because it was 10 years in the making. This was in a Fortune magazine article in 2000. And one of my colleagues, James Montier, saved the magazine because he knew in 2010 he was going to have something to talk about it. What they did was they came up with 10 stocks that they thought these were such wonderful companies that you could just buy them and hold them for a decade. And you could have done that. Several of them even still exist today. But if you bought them and held them, out of every $100 you invested, you would have wound up the decade with about 30. So what was wrong? What had Fortune done wrong? A couple of things. One was they were assuming that the companies that had done well recently were going to continue to, but far more importantly, they completely ignored the valuations of these companies. When Fortune put them on the cover of their magazine, these companies were trading at an average price-to-earnings ratio of 347. To put that in perspective, the long-term average price-to-earnings ratio of the S&P 500 is 15. So these were companies that were trading at over 20 times the long-term average of the market. You need wonderful things to continually happen to these companies in order for things to work out well. And when something goes wrong, you will lose a lot of money. And this money that was lost is lost forever because while a couple of these companies are decently cheap now, none of them are anywhere near as cheap now as they were expensive 10 years ago. Now, maybe we're going to be bright enough not to invest on the basis of what's on the cover of Fortune. But if you're just looking at the overall market and asking, well, does the S&P 500 offer a margin of safety? We would say it doesn't. Now, why do we say that? If you look at this chart on page 6, this shows a PE ratio for the S&P 500, but one with a bit of a twist. Rather than just looking at what the earnings were over the last year, it takes the earnings over the last decade and averages. The nice thing about that is earnings are pretty cyclical. In good times, earnings are very good. In bad times, they're lousy. So the PE can be a bit misleading. But 10 years is long enough to cross at least one market cycle. And right now we are trading about 24 times 10-year average earnings. The long-term average has been between 16 and 17. So the market is expensive to them. It is nowhere near as expensive as it was a decade ago. You can see in 99 and 2000, we were trading at about 50 times, or over 3 times the average valuation of the market. And so it's not a shock that over the last decade, stocks in the U.S. have done pretty badly. Today, we're expensive. We're not as horribly expensive, but we're expensive enough that we think U.S. large cap stocks are unlikely to give a really good return over the next decade. And if we look at why, and we try to get to the details of what should we expect from stocks, the way we come up with our forecasts for asset classes is we say, well, let's assume that the future is going to be normal. Let's assume that the market's going to trade at a normal PE, that profit margins are going to be normal. And if we say at the end of some period of time, and we use 7 years because it's about how long it's taken the average market to revert to fair value, if at the end of 7 years we got a normal PE on normal profit margins, what's the embedded return of getting from where we are today to there? And today, on last year's earnings, we're trading at about 18 times. Now we think normal is about 15. So all else equal, if we've got to get back down to 15, that's going to cost you a little bit every year because the PE is going to contract. But the other concern we have about the market is that profit margins are actually really good today, much better than historical averages. And if they come back down to something approaching normal over the next 7 years, we're going to take a double whammy hit. Not only are the PEs going to come down, but the earnings are going to have a hard time growing. Now, that's the bad news. The good news is we are going to get growth. And with the economy still not fully recovered from the recession, we think overall growth in the economy will be pretty decent over the next 7 years. And finally, you do get some income from stocks. But if you multiply these 4 factors out, what you see is that above inflation, and we think inflation is going to be around 2.5%, there's room to give you much out of U.S. large cap stocks. The PE is too high and profit margins. And so you could say, all right, well, there isn't much of a margin of safety in stocks, so maybe that means we go for bonds. The other piece of bad news is on page 8. If you think about bonds, bonds are actually simpler to worry about than stocks are because you know what you're going to get from income from bonds. That coupon is mandated. Now, if you think about what kind of return should you get for owning bonds? Well, first of all, you should get a return which is at least equal to inflation. You shouldn't be going backwards in real terms. You should get a certain amount of real yield for the fact that you're giving up your cash for some period of time. And then you should get an additional premium for the fact that a risk you're taking is that inflation turns out to be higher than you think. You try to build in reasonable numbers for that, and a fair yield for U.S. government bonds might be around 5%. Unfortunately, today, they yield about 3.5%. So we would say there isn't a margin of safety here, and that's a problem. People think of bonds as a risk-free asset. And while for the first time in a very long time, people are starting to make noises that the U.S. government might not actually be good for the money, even if we assume that that isn't the case at all, that the U.S. government will absolutely make good on its debts, that is not enough to guarantee you a decent return. If we look at page 9, you can see the cumulative return above inflation for Treasury bonds, which up to a 10-year life are called Treasury notes, and Treasury bills, or cash. And this middle period here, from 1940 to 1981, was the last time that bond yields and cash yields were as low as they are today. And from there, we had a 41-year period where both of these assets failed to keep up with inflation, and where bonds in particular lost, even to cash, over every rolling 10-year period during this time. Now, 41 years is a really inconveniently long time. We talk about needing to be patient. We don't mean you need to be patient for 41 years. If something is going to do badly for 41 years, you should just be avoiding it to whatever extent. And we would argue that while things might not be this bad for bonds, at a yield of less than 3.5 on a 10-year bond, you are not getting paid enough for the risk you're taking. And the risk you're taking is that inflation turns out to be something higher than approximately 0. So another trap that it's easy to fall into is getting caught up in people's explanations of why the world has fundamentally changed. The world does change. Technology changes. The countries that are dominant in the world militarily and economically change. But not a lot changes from the standpoint of financial assets, because financial assets are pretty simple. You are giving somebody money. In return, you should get some sort of a stream, whether it's a contractually obligated stream like with bonds, or a stream of profits with stocks. You're giving up your cash, you're getting something in return. Because of that, stocks need to trade at decent valuations to give you decent returns. The same thing with bonds. If stocks are trading at 100 times earnings, there just isn't enough cash around. And so any time you've got a situation where a financial asset is trading far away from where it has historically, chances are it's a bad sign, or actually potentially a good sign. If it's trading very cheap, then it's a good bet things are going to come back up. If it's trading very expensive, it's an exceptionally good bet that things are going to come back down. What we have seen when we look at events which should have seemed like a bubble to a smart investor at the time, they turn out to be bubbles. There are very few situations where stocks that looked horribly expensive actually turned out to be a good investment. The same holds true for bonds. And as a result, if you can be patient and look for the assets that at a given point in time are priced to give you a good return, and be willing to avoid those assets which are priced to deliver a bad return, you can make money. It's not rocket science. It isn't all that hard. It requires some patience and some discipline. What page 11 is showing is our asset class forecasts from the year 2000 and what happened over the next 10 years. So 10 years ago, we thought that the S&P 500 was very overvalued. We thought it was going to deliver minus 1.9% over the next 10 years. It's the worst performing asset we thought available. Now, actually, it did even a little bit worse than that. But the one thing that a lot of investors told us we were crazy for saying was, we were saying that the S&P 500 was going to be the worst performing asset, and yet the best performing asset was going to be a group of stocks inside the U.S. And the next biggest one was going to be emerging market equities, which everybody knew were just like U.S. equities, but more volatile. But it turns out that given that the REITs had a yield of 9% at the time, and emerging markets were trading at about 10 or 11 times normalized earnings instead of the 35 that the S&P was trading at. Even though every time the U.S. stock market went down, emerging markets went down too. The fact that they went down a little bit less each time, and they went up a bit more every time that the S&P went up, meant that instead of losing you 3.5% a year, they made you 8.1. And over 10 years, the difference between losing 3.5 and making 8.1 is a threefold difference in the amount of money you got. So for every $100 you started out with in the S&P and emerging markets, you've got $300 in emerging markets if you invested there 10 years ago. It requires patience.
Let me just interject very quickly. It's important for you to understand that we think in real terms. We haven't really outlined that. It's in the chart. Ben did mention it quickly, but we think in real terms. If you like to think in nominal, then add your inflation assumption. Close to this chart, the one that was prior, and a couple that are coming up.
Sorry, I should have mentioned that. Page 12, I don't want to spend a lot of time on. It's a slightly complicated chart, and probably unnecessarily so. But what I'd like to focus on is this black line, which is the ownership of equities relative to a neutral portfolio. And what this is doing is this is looking at institutional portfolios and saying, when are they overweight stocks and when are they underweight stocks? It turns out the times when they're underweight stocks are when stocks have just done badly. The times they're overweight stocks are when stocks have just done well. This is generally a pretty bad idea. The time you want to buy stocks is when they have been doing badly. And if you're sitting at a time like 2007 where they've just been on a great run and they're trading at high valuations, that's when you want to sell. It's difficult because that's when everybody's talking about how great the stock market is. But you need to do it if you're going to avoid owning stocks without a margin of safety. On On the other side, on page 13, you can see the same thing for holdings of cash. Now, cash is, at one hand, a low-risk asset. Nice thing is, if you've got money in cash or T-bills, it's hard to lose money. But everybody hates to own it. They hate to own it because it is the one asset you can own that you absolutely know you're not going to make your required returns. Anything else, something could happen. Even with bonds, bond yields could fall to 0, and you'd make the 8% that you're looking for. You know you can't get there with cash. In general, people know they can't get there with cash, and therefore people don't like to own cash. But if you're sitting at a time where stocks are overvalued and don't provide a margin of safety, and bonds are overvalued and don't provide a margin of safety, cash is a pretty good place to be, because it buys you the ability to be patient, wait for a cheap asset, and then have the money to go in when there is something worth buying. So I've been taking up almost all my time, but risk is kind of an important thing, and can't avoid talking about it. But we think it's important to recognize risk is a concept, it's not a number. There are 3 kinds of risk that you need to worry about. Valuation risk, the risk of having overpaid for an asset. If you overpay for an asset, you lose money, and that money is gone forever. Second, the fundamental risk. This is the risk that you buy a company, and that company goes bankrupt. Fundamental risk does matter, but it matters less than you think if you own a diversified portfolio. And then third is financing risk. This is important because even if you bought something that was cheap and will eventually do well, if you bought it on margin, if you borrowed money for the investment, you might get called out. You might have that position pulled away from you, and you will never make money. So people who owned asset-backed securities in 2008, those securities got marked down in a way, in a lot of cases, that was irrational. If you just owned them in your portfolio, it was a blip, they've come back, it hasn't really mattered. If you owned them on leverage, like the SIVs did of all of the big banks, you had to sell. You had to sell because you had loans you had to make. And those people lost money and lost it free. In thinking about risk, it's important to understand what risks you're taking with investors and whether, and be on the same page as to what really is an important risk and what isn't. If you look on page 15, this is the performance of our global balanced strategy versus the benchmark. Our portfolio's in blue, the benchmark is in black. In the late 90s, when we were avoiding internet stocks and avoiding stocks in general, by the peak of the market, our portfolio was up 51% versus the benchmark up 83%. And our clients were really pissed with us. They said, how can you have done this to us? You are 28 points behind the benchmark. This is unacceptable. And we lost a lot of trades. But the reason why we did that was we couldn't, in good conscience, own the stocks that were trading at 100 or 200 or 300 times earnings. And we thought that that was taking an unacceptable risk. As a result, when the market turned south in 2000, we continued to make money. And even when the market turned down again in 2007, 2008, we were able to save the clients a fair bit of money. So over the period, we managed to outperform the benchmark, done it with significantly lower risk, and therefore had a portfolio that was about twice as efficient, had twice the units of return per unit of risk as the benchmark, as a traditional portfolio. The trouble was, in order to do it, we had to take the risk of looking stupid. And in 99 and 2000, we did look stupid. And as a result, we lost about half of our book of business. The clients who stuck with us, it worked out very well for them. The clients who didn't stick with us, it was a problem because they fired us. And what did they do? They did a search for a new manager. Whenever you search for a new manager, you ask who's got good 3-year and 5-year performance, and you trot them in and you pick the one you like the best. The people who had good 3- and 5-year performance in 2000 were the people who were doing the opposite of what we did. And so those people made less money on the way up with us and lost more on the way down with Putnam and Janus. If you take too much risk, if the clients don't know why you're doing what you're doing, which some of our clients didn't, it's going to work out badly for you and it's going to work out badly for them. So that's why when we're talking to clients, we want to make sure they understand part of why we think we can deliver a more efficient portfolio is because sooner or later we're going to look stupid. And if you are prepared to look stupid, in return you can get a more efficient portfolio in risk-return space. But you are giving up something. And only for a certain kind of client can it work out. So in the interest of time, I think I will skip page 16. So what can we do now? You've got portfolios which are heavily equity oriented, and you've got a fair bit of bonds. We think both stocks and bonds are expensive. There are a few things you can do to try to spare yourself from the pain of that situation. One is breadth. Make sure you are looking at a broad range of assets. The broader a range of assets you have to look at, the more likely it is that there's something out there which is decently cheap. And for your managers, the more breadth you give them, the more ability you give them to look around the world for cheap assets, the more likely they're going to be able to find it. Second is concentration. It doesn't do you any good to have Japanese small cap stocks as part of your portfolio if you say, well, they're part of my portfolio, but because it's a small part of the investable universe, I'm always going to have 0.5% of my money in Japanese small cap stocks. If Japanese small cap stocks are the cheap asset out there, you have got to have the willingness to say, well, I don't care that they're only 50 basis points or 0.5% of the investable universe. I want to own a significant amount of them because they're the cheapest thing out there. And finally, we think it's important to be willing to hold cash. If you're not getting paid decently for the kind of risks you're taking, take less risk. And so if you look at what we're doing with our portfolio based on that today, page 20 is the core behind everything we do in asset allocation. They are our asset class forecasts. We went over the one for U.S. large cap slightly earlier. As Drew mentioned, we tend to think about things above inflation in real terms. We do that because at the end of the day, that's what matters for the end beneficiary. But if you care about the nominal returns, add 2.5% to these numbers. But if you add 2.5% to these numbers and you say, all right, well, what is there out there that's going to give me 8%? There's almost nothing. Right now, we think there is one asset class, timber, which is priced to deliver 8.5. Now, why is timber priced to deliver 8.5? One reason is if you buy timber, you're giving up something that people really like. You are taking on an attribute that everybody hates, which is illiquidity. If you buy a forest, you cannot sell that forest next Wednesday to invest in something else. You're there for a long time. As a result, timber tends to be priced to give a pretty good return. Stocks are often priced to give a good return. Today, not so much. But there are, if you're willing to look broadly and you're willing to concentrate on those areas of the market which are cheaper, there are some things worth buying. One group relatively close to hand is a group we call U.S. high-quality stocks. These are companies that have high, stable profitability and low debt. Companies like Coca-Cola, Microsoft, Walmart, Oracle, Johnson & Johnson. Big, stable, boring companies. You know they're not going to make you rich from them. But the nice thing is we don't have to imagine wonderful things happening for Microsoft or Walmart in order to get a decent return. They are trading at 10 times earnings, 12 times earnings. If they simply don't screw up badly, you'll get a good return. You compare that to Netflix. Netflix is trading at 80 times earnings. It's also growing fast and has a really good service. But if anything goes wrong, Netflix is going to give you a bad return. As we look outside of the U.S., we think the emerging markets are significantly cheaper. We think Japan, after their recent catastrophes, is significantly cheaper. Unfortunately, on the bond side, there is nothing that is particularly cheap or priced to deliver a lot of return. So when we're putting together our portfolios on page 22, whether it's a balanced portfolio, which is managed against the benchmark, which looks not all that dissimilar from your benchmark, or a more absolute return-oriented portfolio, we are biasing the portfolio in the same way. If we own stocks in the U.S., it's all high-quality stocks because they're the only ones priced to deliver a decent return. Outside of the U.S., we like emerging markets, and we like Japan. For the money we're not going to have in stocks, and we don't want to have an excessive amount in stocks because they are generally expensive, we like cash over bonds. Because the nice thing about cash is if something goes badly wrong and a market winds up cheap, you know you have the dry powder available to exploit. So, you know, you can say, all right, this involves moving the portfolio around a lot. And, you know, if you guys are a big institution, maybe you feel like you don't have the flexibility to do that. I think you've got more flexibility than you think, because this does require turning the portfolio around on a dime. If you look on page 23, this shows the actual evolution of our global balanced portfolio over time. And there's a lot of stuff on this page. There's a lot of different colors. So it can be a little bit confusing. But what I'd like to look at is a few examples of situations where there was a cheap asset, we tried to exploit it, and then we got out. So if you look in yellow, real estate. Real estate investment trusts were quite cheap in the latter half of the 90s. So they were a significant part of the portfolio, growing by 2000 and 2001. They were about 10% of the portfolio, even though they were only about 1 or 2% of the US stock market. But then they outperformed. They did quite well. And we sold. But it's not that we had to do that selling immediately. We had time to get out. And we had time to get into areas like high-quality stocks, which we started buying in 2004, but didn't become a really big part of our portfolio until 2007, 2008. We think you need to have a willingness to move your portfolio around, but it doesn't mean you've got to move your portfolio around every day, every week, every month. We've averaged about 3 or 4 changes to the portfolio a year, and that's enough to make that portfolio nimble enough to find the cheap assets.
What's strategic fixed income?
Strategic fixed income is a poorly named fund. It is a bond fund that we have the flexibility to move it around to where we think the opportunities are. So a few years ago, it was asset-backed securities, which we thought were pretty cheap. Today, it is Australian and New Zealand government bonds, which have the sadly unique factor right now among global developed government bonds that their governments have sustainable policies. They can continue to run the kinds of deficits and debt levels that they have and still be able to pay off their debts, and they actually give you a decent yield. So U.S. bonds yield 3 or 3.5%. Bonds in Australia and New Zealand yield 5.5 or 6%. Better yield, more safety is a pretty good combination for us. Now, again, they're a tiny piece of the global government bond market, but they are one of the few places we're finding value in bonds. And so we're willing to own them at 10 times their weight from a kind of global market capitalization perspective. We're willing to have that kind of concentration, and we're looking across those kinds of assets. If you look on page 24, and I'll just leave you with this, this is a similar portfolio, but with a slightly different mandate. Instead of beating a particular benchmark of stocks and bonds over time, the job of this portfolio is to deliver 7 or 8% Now, we want to do that in the long term. So we certainly can't guarantee that we will do that in any given year, but everything we own in this portfolio, we own because it's helping us towards that goal. It's either something that has a decent return associated with it, like quality stocks and emerging market stocks, or like the absolute return portion, it's providing dry powder that we can put to work in markets if something gets cheap. We're willing to hold the cash today because today there isn't much worth owning. If you want to be in a position to put money to work in a time like 2009 where there's a lot of cheap assets out there, you've got to be willing to hold cash when there aren't cheap assets.
Okay. Excellent. I have a couple of questions in going back to page 21.
Yep.
Now, the dotted red line and the number there, that's your expected return over the next 7 years. What do you mean by equilibrium?
So,
Expected return.
yeah, so equilibrium is if stocks were trading at fair value, if we were trading at 15 times earnings on normal profit margins, what do we think stocks would deliver? It's another way of thinking about it is what do we think you deserve to get for taking on the risk in stocks? And this 5.7 is again in excess of inflation. So we think in general for buying stocks, if inflation is 2.5%, you should get 8 or 8.5% out of stocks.
So you would only buy stocks that were at 15 times?
So I am
Or
happy,
an average?
I am happy buying stocks when they're 15 times or less. When they're more than that, I start wanting to own fewer stocks. Because it's probably, even if I can put together a portfolio of stocks that is trading at less than 15 times earnings now, the stocks that are cheaper than the market are often cheaper for a reason. So the more expensive the overall market is, the more dangerous it is to own stocks, even when those particular stocks aren't that expensive. Today, we think that the U.S. stock market is very expensive. In particular, U.S. small caps are about as expensive as they have ever been in history, and we think they are a very bad investment.
That 15 times is for each of the sectors? Large cap, small cap, and high quality?
So for large cap, it's 15. Small caps, we think normal PE would be about 16 times earnings. For emerging markets, it's about 14 times earnings. For high quality, it's actually about 17 times earnings because they've got some nice features to them. But that's kind of the gravitational pull. That is what we think those assets have to revert around over time. And the other bars on this page are showing what our forecasts were in 2007,
Yeah.
and then near the bar at the bottom in 2009, and then again today. Stocks were really cheap for a while in 2009, but they've gone on a heck of a rally since then, and they are no longer anywhere near as cheap. Some of them aren't bad, but none of them anymore are cheap enough.
And page 22, could you explain this chart again?
Sure. So the left-hand bar is the benchmark of our portfolio. It's managed against 65% global equities and 35% bonds. That is the benchmark we're trying to beat over time. The right-hand side is the actual portfolio we're running today.
Oh, I see.
So we've got a little bit less in U.S. equities, and if you look at the U.S. equities that we hold, it's all quality stocks. We own more emerging markets than are in the benchmark because we think they're cheap. We own a lot less in traditional bonds because we don't think bonds offer a margin of safety here. And even in those bonds that we own, the strategic fixed income fund, which is most of it, is actually Australian and New Zealand government bonds, which are not normally what one thinks of when one is looking to put money into government bonds.
Oh, I see. In the securities that you list on the far right, or what's actually in the
portfolio.
Oh.
So this is a strategy which is made up of a number of underlying funds. And you've got the names of the funds over on the right. And so because of the tilts we've got in the portfolio, we think we can deliver more than the benchmark. But the trouble is, in yellow, we think the benchmark, if our forecasts come true, you're only going to get 1.4 plus 2.5 inflation. You're only going to get about 4% from a traditional benchmark. Today, we think we can do better. 4.2 plus 6.5, that's 6.7. That's still not 8. We think it's a really hard time to try to get close to a double-digit return because stocks are overvalued and bonds are overvalued. So what are we doing? We're trying to run a somewhat lower risk portfolio so that if the markets go down, we can view that as an opportunity rather than a disaster. And we want to tilt our portfolio if we're going to be taking risk. If we're going to own equities, we should own the equities that are priced to deliver a halfway decent return.
What's alpha only?
Alpha only is an absolute return fund.
Okay.
It's
All right.
kind of like a hedge fund and a mutual fund capital.
Okay.
So then you started by talking about our equity risk concentration, and if you look back over 30, 40 years, a lot of that has come from declining bond yields and the fact that we were trying to meet this 8% bogey. What's interesting about your 2 yellow boxes is that a lower risk portfolio actually has a higher expected return. Can you comment on that over time? And because a lot of our conversation about asset allocation is how to do just that. How, if possible, we can reduce the volatility of our portfolio without actually compromising our ability to find high return generating assets.
Yeah. So how can you do it? Well, we've figured out a way that we think we can have a higher expected return with lower risk, if risk is defined as the risk of losing money. And that's by being willing to take a different risk, career risk, the risk of looking stupid if U.S. small caps happen to be the best performing asset this year. We don't own any, and we're underweight stocks in general, so we are willing to run a portfolio which has tracking errors to the benchmark, will underperform under certain circumstances. Now, just because you're running a portfolio that's different than the benchmark doesn't guarantee that you're going to win. What we're trying to do is look out for which asset classes are priced in a way that if the world is fairly normal, you'll get a good return, and focus on those. The market has a hard time having the patience to do that. And so we think if you're willing to do that, you can put together a portfolio that has a higher expected return and lower risk. What are you giving up? One is an ability not to do anything. You've got to be paying attention, and even though you don't have to move that quickly, you do have to periodically look around and say, well, gee, U.S. stocks are no longer priced to deliver a decent return. Let's find someplace else to put the money. And the other thing that you've got to do is either have the willingness as an investment committee yourself to take on that bet, to say, yes, we believe U.S. stocks are overvalued. Let's move the money out of the U.S. Let's move the money out of stocks. Or be willing to hire a manager and give them the authority to do it. Not all that many investment committees are willing to do either of those things, right? They hire managers and put them in a very tight box. They say, you are a mid-cap growth manager. If mid-cap growth stocks are expensive, we don't want to see you owning large-cap value. And most investment committees really want to say, here is a portfolio mix that I can have for all time. The trouble is there is no portfolio which is a good idea at all times. Since we think a very important piece of true risk is the risk of overpaying for an asset. You've always got to be looking at the price you're paying for every asset that gets in your portfolio. No asset deserves to be in there regardless of value.
Follow-up questions. Is timber in here somewhere?
Timber is not, because this is a portfolio which is liquid. This is a portfolio where the client can say, I need my money back tomorrow.
Okay. All right, so that this particular client doesn't have any private equity or real estate?
Right, this is only a liquid portfolio.
Oh,
This, yeah, it's only stuff in liquid capital markets. Private investments in general are not part of it. And private investments can be an important part of a portfolio. You know, in the case of something like timber, we think it's cheap because people don't like the illiquidity. Private equity is a slightly different case because those companies could be public. One of the ways we think about private equity is it's a really good way to harness security selection skill. If you've got a really smart manager who can find cheap stocks, and if they find a cheap stock and can buy the whole damn company, they have much more ability to outperform than a standard guy who's going to put 1% of his portfolio and buy a little piece of the company. The trouble is, they need to be smart. If they're not better than average investors, then you're just winding up with stocks, and it's less liquid.
last question. How many of your clients are executing your absolute return strategy that you illustrate here on page 24?
So on page 24, we've got about $4 billion of assets and maybe 60-ish clients in it.
All right. Okay.
We've got some other absolute return strategies, which are actually a little bit more aggressive than this, which have another $5 or $6 billion.
And what would you say the range of your clients' portfolios were in this strategy?
It ranges from 1% to 2% to 50% or more. Most of them are at the smaller end, but we've got some foundations who have the bulk of their money in a strategy like this.
Full disclosure, these two portfolios were put in the book because they're illustrations of kind of bookends, a traditional benchmark-driven portfolio and one that's not, but this one on page 24, in fact, is closed at the current time. So just for illustration, and I think it worked well that way.
Well, a word that's come up a few times in Ben's presentation is patience. And I think you've been very patient with us and generous with your time. And if there's anything in sort of the last question that you'd like us to address to make sure this has been as useful as possible, we'd be glad to. But we're grateful to you.
Thank you.
Thank you very much.
Thanks very much for your time.
Warren, do you have a handout?
Larry, I'd like to have that discussion now proposed before we move to the next agenda item.
Is that a public discussion or new?
However you'd like, you wanted to have it earlier, so I'm happy to do
Yeah,
that.
Are you later?
yeah.
Okay.
Okay, stick with the agenda. Martin, you want to talk about opportunistic fixed income?
Indeed, I do.
Excellent.
We have a color version being passed down of our presentation. We also have it in the agenda package on page 57 if you want to read it in black and white. Everyone okay? So in this presentation, we look at the fixed income markets as well as we'll be making a recommendation at the end to increase the allocation to the opportunistic fixed income program. And just so there's no confusion, we do label this elsewhere as strategic fixed income, so we're talking about the same thing here. In addition to the increase in the size of the program, we are going to be talking about some new types of investment structures for the program. In a brief history, you'll recall back in 2008, the program was established in order to give the board the ability to invest in fixed income investments outside of the traditional investment grade and high yield mandates that we've had for years. So if we turn to slide 2, we have a pie chart that approximates the universe of investable fixed income, and the present Core Plus 5 investment grade and high yield programs, as well as convertible bonds and TIPS, would be shown in the large slice on the right. These are the traditional fixed income investments, and they're mostly public market securities. However, about 40% of the overall investable fixed income universe, a large opportunity set, falls outside of these programs, and that's shown on the left. And it includes stressed and distressed assets, many structured and securitized assets, and most private debt, including real estate debt. The opportunistic fixed income program that was established was done to consider investments in the categories on the left and allows NYCERS to broaden the fixed income opportunity set. On slide 3, we note that fixed income overall offers diversification to your equity portfolio. It also provides liquidity and current income. However, the market conditions, you just heard GMO talk about it, you heard PIMCO talk about it. The market conditions are offering historically low yields and tight spreads. To give you some context, and it's actually the same numbers that GMO mentioned before, but at the beginning of the month for the Core Plus 5 year investment grade program, where about 15 to 20% of the assets are invested, the yield to maturity is now 3.5%. That means, barring any defaults and all things being held equal, that spread relationships change or don't change over the life of the investment, which is 5 to 7 years. You would expect to earn 3.5%. High yield, the yield to maturity for your high yield program, or enhanced yield, is less than 7%. So it's not really living up to its name. On a historical basis, it's, on an absolute basis, very low. In the opportunistic fixed income space, due to illiquidity and inefficiencies in the market, and also specialized knowledge that's needed, investors can achieve a higher return. I want you to turn to page 4, where we show the investments that we've made to date in this program. And each one of these investments have done well. But one thing you'll note is that each of these investments were in funds that were raised and targeted to institutional investors and are in specific and discrete funds. And each of the funds specialize in a particular niche or specialized areas, such as RMBS or residential mortgage-backed securities, CMBS, senior distressed debt, and of course NYCERS is invested in the PPIP funds. On the next page, we show a chart going back 10 years of fixed income yields. And as you see in most cases, as we go to the right to the current time, the yields have come down to very low levels that are not attractive on a historical basis. You heard GMO talk about risk-free yield treasuries. We also heard about, from PIMCO, about S&P and starting with Treasury and the potential for downgrading. But generally, Treasuries are referred to as risk-free yields, but given the low level of absolute return and very little cushion that you have, we would almost refer to these not as risk-free yields, but yield-free risk. Because when interest rates go up, you're going to end up losing principal as you hold these securities, and we'll talk about that in a little moment. But there are opportunities to make money in fixed income. And page 6 lists some of those, and they include corporate stressed and distressed assets, many structured securities, private debt, including the ability to buy debt directly from, or buy securities and portfolios of securities directly from banks that need to be levered. And this is in the US and in Europe. And you should also be aware that we have very little exposure to European debt overall. It's mostly a US-centric portfolio. But there's no free lunch. There are higher returns here, and coming with the higher expected returns, of course, comes higher risks. And we list some of those on the next page. And the first one we note is, of course, the higher volatility returns. The Core Plus 5 has volatility historically in the 4 to 5% range. If rates go up sharply, we would expect that would go up a little bit more, but not much. High yield is a little bit higher. Equity returns have volatility. Mark Klein, you can help me out with this, in the teens, upper teens.
Low mid-teens. Yep.
We've seen historically over the last cycle, it was the upper teens. We would expect the opportunistic program to be above the traditional fixed income volatility, but below the public market equity volatility. But that is a risk of the program. In addition, many of these investments are illiquid. In fact, indeed, many of these securities are privately traded. Now, illiquid is always on a relative basis. You can have securities in the high yield portfolio that don't trade but once a month. And you can have distressed debt securities that trade every day. So it is on a relative basis, but you can be assured that in the opportunistic space, all things being equal, there's less liquidity for these securities, certainly with private market transactions. On the positive side, many opportunistic fixed income investments have better alignment of interests. What do I mean by that? They have better collateral, they have better covenants, and in many cases are senior claims on assets. So there is significant downside protection in your investment grade program, Core Plus 5, and to a lesser extent in your high yield program. While you have very good liquidity, you also have significant duration or interest rate sensitivity. So when interest rates go up, the value of the portfolio will go down. And we saw that when rates went up from 2.5% on the 10-year to 3.5% on the 10-year in the space of just a few months. In November and December, the Core Plus 5 investment grade index and portfolio went down about 1% each month. So high quality fixed income can go down if interest rates go up. There is significant sensitivity there. In the opportunistic fixed income space, distressed debt or floating rate notes or private transactions have very little interest rate sensitivity, but what they do have is credit risk. They have liquidity risk, and they have some of the other risks mentioned on the page. On page 8, we recommend that the board consider increasing the allocation to the opportunistic fixed income program in lieu of the low expected returns that we would be looking at over the next market cycle for the traditional fixed income program. The exact amount of the increase, of course, will be determined through our asset allocation process, but we would expect it to be somewhere in the 3 to 5% range. Just to give you some context, the policy right now is that 5% of fixed income, which comes out to 1.5% of the total fund. So 1.5 up to 3 to 5%, but that's still TBD. In addition to the increase, we're also working on a plan with staff and consultants to bring to the board investments that are very different from how we brought you investments previously for these particular investments. And that is, in the past, we've brought you funds that were raised and targeted to institutional investors that identified a particular area of the market where there were inefficiencies, and there was a premium to be collected for those who have liquidity. But what we're looking at here is partnering with several managers for what we're going to call strategic mandates or core mandates, where the managers have demonstrated capabilities across the credit landscape in different areas, not just a focused area. If you go back to the page where we have the investments, most of those funds that we're in are focused in one, we'll call a niche area of the market. And these core mandates would be allowing the managers much greater flexibility to be nimble and invest where the opportunities truly are. So if we're in a fund right now The lockup period could be 3 years, 5 years, could be more. The opportunity could be gone, but our dollars are still tied up. In these mandates that we're contemplating here, and that we, by the way, will be bringing to the board, we'll be seeing these over the next several months, we will have the ability to give the managers, where they demonstrate expertise, the ability to invest across the credit spectrum where the opportunities arise. And in this way, we believe the fund and the accounts and the managers will be able to be much more nimble and truly opportunistic. In addition, when we're in a fund, the assets are tied up, as I mentioned before. Our expectation here, and we've been working with staff and counsel on this, is that these would be accounts that the fund would own. We would have complete transparency over the securities. We would have better terms and fees. In short, we would control the assets. There would be a much better alignment of interest between us and the managers. And we would allow the managers to be truly opportunistic in this space across the credit landscape where we believe they have the capabilities.
So, Martin, if I may, from what I'm hearing, I originally thought you were proposing something like private equity in the debt market, but from what you ended up, it's actually somewhat dramatically different in that we'd always be the custodians of it, or Sam would actually be the holders of it.
The structure of the fund would be similar. We're working on that right now, but it wouldn't be very different from the private equity structure where you have a fund with a GP and an LP. It would be a fund of one, effectively. New York City would be the investor. And we would have full transparency over the assets. We would be able to, if there's an issue with the manager, terminate the manager at will, and then assign the assets to another manager, or liquidate, or have a plan of liquidation. We would
So in other words, there wouldn't be a lockup period.
No.
Now, let me correct you what's becoming a false impression. This is just an account.
Right.
It's just an account. If it looks like a partnership, it doesn't matter. It's not at all like private equity.
Thank you.
It's
That's
a
why I
very
was-
liquid trading account. Instead of just being an account at a money manager, we just set it up as a partnership. We're the only person in it. We can terminate it whenever we want and sell the securities. You know, as long as the securities aren't in very illiquid securities or in private placements or things like that, which would be acceptable. But it's real. You should view it as a very nimble, actively traded, separate account.
Yeah,
Unlike the
but
fund,
they're telling
unlike
us
the funds that we're in right
they're,
now.
they're just making the recommendations of what to buy.
But they do it. It's
They're
like giving
buying.
money to PIMCO.
Okay,
They trade.
they're buying.
They're money managers.
They're 100% money managers.
We set up
The
the
difference
guidelines.
is, if I can make it simple, the difference is, instead of all of the sub-asset categories that we have, mortgages, tips, high yield, this is money that has much more discretion.
Within credit.
Within credit. So to the extent that it starts as high yield, and high yield moves into distressed debt, and distressed debt moves into leveraged loan, the manager can do all that without talking to us. And we've researched to make sure these managers can do those three things. So you basically, you agree on some terms, you let them be nimble as to where the markets are, so you end up with a chart, kind of like that GMO chart where it kind of moves around. We don't have any debt money that moves around. We have it in very watertight buckets, regardless of where the opportunities are. And the only way for us to capture opportunities then is to see an opportunity, either have someone package a product like PIMCO Disco, or have an RFP, and then we have to wait a month, 9 months, or 6 months, or something. This is about find some opportunities today, which we will come back to when we lay that out very specifically for you. Find the best managers to handle that, and then let them go do it. And if any time we decide we're done with this manager, we fire them. Take our assets, or we have them liquidate our assets, whatever we prefer, and then we move on. And the concept that Martin laid out is we'll have some bigger partners, say $500–600 million, and some smaller guys, $200–300 million. And when you add the whole thing up, you've gotten to 2–4% of the fund in these different galaxies, if you will. But they're all in things that we really aren't in now, and the opportunity might cut across from the U.S. to Europe, because we don't have a lot of exposure to credit in Europe. So if you look at Europe, you have all these banks, they're gonna start selling things, we actually don't have any way to make money on that. So there's an opportunity set out there, we're not set up to do it. We could have an RFP, but if we had some guys that would take the, say it was high yield or loans, and they said, look, we think the opportunity is in the US, but it's gonna move over to Europe, we say, great, you guys have a very good operation in Europe, move the money. And they move the money. So to them, it's just trading from sort of US loans to European loans, back and forth, and the money is very fluid. And that's what, we don't have any of that.
Okay.
And there's guys who do this very, very well, with long track records, with big businesses.
Jackie?
Slightly different question. Can you talk about how this would compare to what we may do through hedge funds? Should we move on through asset allocation with hedge funds?
Hedge funds, you want to do the hedge fund? What a credit hedge fund is versus this? See
Yeah,
how you
I
want?
mean, mostly it's just that what Martin is talking about doing in opportunistic fixed income is investing with managers that primarily are going long, not long short, for generating excess return. So
There will be cases where they have some hedging. So for instance, they go into a country, they buy security in the country and they want to hedge out the country risks, so they do that. But they're not, for the most part, looking to add value, to add alpha through shorting, through traditional or non-traditional methods. This is mostly long only. It won't be only long only. But it's very different from the hedge funds and where it's not really absolute return. We're looking for an absolute return and a higher return from this, but there will be, for the most part, long exposures to European credit, to leveraged loans, to structured credit, to U.S. distressed credit.
A little more
So-
credit-based in the analysis rather than trading-based, is the right way to look at it.
But fair to say, though, that while these guys look different from hedge funds own a lot of what these guys also own. They just have other strategies within their portfolio. So this won't be our only, there are plenty of hedge funds that do distressed debt, right?
Sure.
Almost every multi-strategy fund, by definition, does distressed debt. They also just do other things as well.
that's
And
right.
they will go long and short.
Right.
So this is not the only distressed exposure we will have in our portfolio.
That's
And
right.
what we're trying to come up, what we're trying to come up with is who's the best at a certain category of assets. And then have them sort of be our lead guy in that, with one or two other guys around it. So that you take sort of what I'll call the geography of debt, and then have some guys who are corporate, some guys who are making this money in real estate, some that can do US only, some that can do global. And kind of lay it all out, we'll come back to you with sort of a plan as to, here's the map, here are the managers we expect to cover that area of the map, and you'll see that most of the map is sort of colored in. So we have exposure, and again, they're not watertight compartments, but they are, we want to make sure that if it's a US only guy, he's not buying European debt. He might come to us and say, I'd like to, the answer is, might be, we have guys who do that. Otherwise, we find ourselves competing with ourselves, or our managers competing with themselves too much.
What is the advantage of having these folks do this program versus transferring out those responsibilities to the hedge fund space where we've already decided to enter? What is the logic? What is the advantage of doing that? Cost-wise, division of the board,
I would tell you that
attention-wise?
they're different investment strategies.
But-
At the heart of it, the shorting is a big deal for the hedge funds. It's not a big deal for these guys. These guys really only do it to protect something. And they're they take, a lot of it might be, for instance, they want to own a company, so it's distressed for control perhaps, or it's working in the bankruptcy process. Hedge funds don't really do that. They might cruise around the deal, buy something, short something, but it's a different strategy. It's a different way to make money.
But isn't there an overlap? What I
Yes,
just
there's-
heard that there's an
there's
overlap
overlap.
between
There's
hedge
overlap.
funds and this fund. So
Yes.
I just, if there is an overlap and there are people in hedge fund world that are exceptionally good and nimble at this, I'm just
In fact,
asking, are we maximizing our efficiency by splitting
yes.
this
What
up?
you also find is you're going to find some of the managers that we give a lot of money to, we also have a little bit of money in their hedge fund. because these are good managers. These are just different products that they have. So if you're a really good credit manager, you might have a private equity fund, you might have a hedge fund, and you might have some strategic partnerships like that. That's how you set your business up to accommodate your customers. So we might be in all three of those structures, or we might decide, yeah, you know what, we don't want to be in a hedge fund for some reason, but we like their private equity fund. I mean, because again, a bunch of these firms have gotten really big and really into different products. So let's take someone that's big in alternative, Blackstone. They don't have a hedge fund, but they have real estate, they have mezzanine, they have private equity. We're in their mezzanine, real estate, and private equity. There's other guys like Apollo that have all that, plus a hedge fund, plus more credit funds. And when you get to a certain size, the way they're structured, they have a lot of research and ideas floating around, and what they're looking for is different investment pools to put the ideas in. But there's a big infrastructure that they've built, and it fits different kinds of investors depending on what you're looking for and what they charge you, quite frankly. And if you're locked up or not locked up. And we're trying, this is something we're not locked up at all. We might end up buying something that has longer duration, that is unregistered, that is illiquid, but we'll put constraints on it. So for instance, take mezzanine debt. We don't have a lot of mezzanine exposure. Mezzanine debt comes and goes as an asset class because when mezzanine debt's good, probably the high yield market isn't so good, or a portion of it isn't so good. But the way mezzanine debt funds are raised is as private equity funds, where you're in a fund for 10 years. It's not a 10-year opportunity. It's maybe a 2-year opportunity. But the structures don't really fit that because it's not sort of in the manager's interest to have it be that fast. We might, in this construct, pick up a few mezzanine investments without having a mezzanine fund, which would be good for us because, again, on the margin, it's stuff it would already have. But it's all inside the mandate of its credit. They have a mezzanine fund, but it's too big for their mezzanine fund. They have a pocket like ours that takes a piece of the deal. And again, that wouldn't be in a hedge fund. It's just different. You're trying to have, from our perspective, we're trying to be nimble because we're not nimble. From the manager's perspective, they want flexible capital because fundraising is actually a big pain in the ass. And the way they partly avoid the big pain in the ass is they go out and lock up your capital, like our private equity portfolio. The debt opportunity, you'd like it not to be so locked up. You'd like to really be able to move with the opportunities because the opportunities move as credit moves. So it's just a different thing.
Larry, if I may though, I think Jackie and Ray make a very important point. What you are describing is differences in business structure and business model. What they're asking is the underlying risk exposure, and we have credit in multiple places. And we have distressed credit in multiple places. So I think this, again, comes back to the huge need for risk look-throughs, because even if we have 3.5% to 5% in this kind of allocation and another similar exposure to credit, to hedge funds, we could have an aggregate 7% to distressed credit.
Good.
So the question they're asking is exactly right, which is, in fact, there's a lot of potential overlap. And in many ways, when these guys are giving us our money back, the hedge funds are not investing in credit either. There's a lot of herding. People don't disagree about when distressed credit is attractive. There's a lot of agreement because these guys are very often looking at similar types of trades. So I think that there is a real chance that when the opportunity is the most attractive here, that we actually own a lot of distressed credit somewhere else too. And I think both their questions about looking across these portfolios to understand our total exposure is really the right question. That said, I think one of the most creative things BAM has put in front of us is the structure that you are proposing here. Very creative, allows us to manage an exposure. We are making the strategic bet into credit, but we are letting our managers pick which security. So we are taking systematic risk, which we have in our long-only PIMCO type portfolios, and really changing that to idiosyncratic manager risk, the ability for these managers to find these companies and these really, really cheap, to the GMO point, opportunities to invest. So I love the structure, but I do think we should not underestimate that this is a lot of credit exposure that we have in other places.
Actually, we don't have hedge funds yet.
No,
Right.
could,
So
right?
ultimately, we'll have hedge
Both
funds.
will be parallel tracks.
Right,
so-
ultimately, you move the capital in sort of parallel. Parallel tracks is absolutely the right word. As we move into hedge funds, some will be credit, some will not. This is credit. And then the challenge is to track where the risk is, to your point. It actually doesn't bother me if the hedge fund guys and these guys all decide one day that distressed debt, let's say, in Europe is the place to be. We just have to keep our eye on it and track how big our exposure got to it, because it's 1 + 2, right?
But if you're thinking of an asset allocation study and you say you want 5% in distressed credit and you want 3.5% in dedicated strategies, you have to allow that half your hedge funds could be distressed credit. I'm making this up. But the
Perhaps.
allocation should look at all the sort of places where distressed credit could be purchased because of the guidelines we've given our managers.
Right. I agree.
I've sort of made some notes all along because this is a broad topic, and I think it gets into an awful lot of what's been discussed today by PIMCO, by GMO, and opportunistically here, also through asset allocation, and ultimately I think will come through in terms of what asset allocation is adopted, but there's an awful lot of other issues. So let me sort of comment on 5 or 6 of the points that came out, and in no particular order other than sort of the order I've got them jotted down. To Ranji's point about the risk management and understanding your exposures across the portfolio, that is something that I think BAM is in the process of working in. It's been obviously a big discussion at this level throughout. It plays through in asset allocation, but it's also important to understand where your exposures are outside of asset allocation. One of our people in San Francisco, I know, has spent quite a bit of time already with Catherine on that issue, looking at various ways of getting your arms around that. I think that would be an ongoing issue, but it's an important one that over time you need to be able to get your arms around.
And Mark, we are going to be structuring this so we do have transparency
That-
to be able to look through to see what
Yep.
the securities are.
Martin, it's exactly to point 2. Jackie had raised the issue of what are some of the differences between hedge funds and this, and Martin had identified an awful lot of them. The one he didn't describe until just then was the issue of transparency. That is one of the issues that will be different here, and I think is an important one to keep in mind. Ray, you had raised the issue of, and it really is a valid one, of sort of as we go across the investment spectrum, we begin to have some levels of overlapping talents, skills, investments, and so forth. And I think that in fact that's true. But in fact, I think one of the other things that we've been discussing through asset allocation, we heard from Bridgewater last month, we heard from PIMCO and GMO today, is the idea that the old way of simply categorizing investments by what their asset class is not necessarily the way that portfolios will be put together going forward. It is a big part of what will be put together going forward, but what we've seen over the past few years is that at different times, there are opportunities that come up. And I think what the idea of investing in hedge funds is exactly that. It's an opportunistic form of investing. It's different from allocating to equities or fixed income in fixed amounts. That part is still going to be the core of your portfolio, but you're going to have other investments that you will have to decide to adopt. Hedge fund allocation is one, opportunistic fixed income is another as part of asset allocation. But then down the road, there may be other implementation ways of doing things that may give managers more flexibility in order to be able to invest in a more opportunistic way. So I think, in fact, as we've talked about here, there are overlaps among the types of investments that each of these types of opportunistic managers, whether they're hedge funds, opportunistic fixed income, or other things, that there will be overlap. but I think some of that is in fact designed, and some of it is designed to get to a more improved way of managing your overall portfolio. The last couple of points I guess I wanted to make is that remember that you already have opportunistic fixed income investing as part of your strategy. As Martin talked about, you've got an approved allocation of 1.5%. He indicated we've been working with NAM in terms of sort of what level may make sense and so forth. I think an increase makes sense in that for the reasons that we've talked about here. We particularly like the approach of identifying managers with broad skills who can make the opportunistic investment themselves, where to go at different times. We think that's a challenge for BAM to do by themselves. We think it's a challenge for this board to do, and it's certainly not something that Cal and your consultant can come in and say, opportunistically, we think now is the time to invest in this for the next 6 to 9 months. That is what you pay a manager for, and we think that's particularly useful in a good strategy here. And the last thing I would point to, Martin did a very good job of identifying the risks on page 7 of this presentation. One of the things, again, to keep in mind, this is fixed income investing, it's opportunistic fixed income investing. The returns are higher, the risks are also higher. It's part of what we understand this as we go in, but it's something in terms of managing expectations of the board. I think these risks are important to understand. And as part of when you get to the decision process about implementing, it's an important thing to keep in mind. We think it's a valid and a good way to be investing. I think it's something to keep in mind. So just sort of tying in everything that came up may be helpful there.
Can I just comment on that last point? Callum actually did not pull out distressed credit opportunistic in your asset allocation presentation to us as a return and risk category. So if you could help us actually understand that.
Yeah.
Even if your company come back.
Well, when we do, we will be. That, in fact, is something we've worked with NAM on. I think it's, again, the idea of opportunistic, trying to determine what the expected return and risk should be from something that's called opportunistic is a challenge in itself. I mean, first of all, who knows what the opportunities are going to be? Who knows what the markets for those will be? By their nature, they're very difficult to establish. And I think as a result, you need to look at those with a little bit more of a cautious eye in terms of what they really mean in terms of expectation. Broadly speaking, the assumptions that we've developed that we'll be using will be, as Martin indicated, in the range of higher than traditional fixed income, lower than equity, with a risk level in between. That's about the best I can define it at this point.
So if I can just share the numbers from the other 3 consultants who did have numbers, returns were 6 to 9%, and volatility was 9 to 19%. And the one manager we do have in this space actually has shown equity-like volatility, not half of it between stocks and bonds, but equity-like. And the correlation, as Axia pointed out when they came to present with them, was 0.9 to equities. So this is a mixed bag. This is exactly your point, and it is we really look to BAM to lead us through this.
And we would expect to fund that from the equity portfolio itself, and we'll talk about.
But it's not necessarily the diversifier we think it might be, particularly in a credit crisis-driven situation.
When correlations go to 1, nothing is a diversifier. But we would say over the longer term, it is a diversifier, and that the volatility that you see is a function of the environment that we've seen over time. But if you look at a longer time period, it does fall into what we would describe as higher than traditional fixed income and below public equity.
Well, because I'm trying to broaden how we think about risk in a mean variance framework, you're exactly right. But this just is more exposure to a growth environment, more exposure to what we already have a lot of exposure to, strong economy, strong earnings, companies doing well. And these are very cheap assets. I like everything we wanted to do here. I like the fact that we're not systematically buying indexes, which we have a lot of overvalued stocks. These guys really look for troubled, cheap assets. But in terms of the overall risk, this is a return opportunity more than a risk diversifier is the only point I think we should not lose sight of.
But what I would talk about the risk diversifier portion of this is what we mentioned before, and that is for most of the public fixed income markets, there's a lot of interest rate sensitivity, and you don't have that here. So from that risk perspective, there is a significant diversifying effect here. I understand what you're saying.
A very small part of our portfolio, which we need more of. The big risk in our portfolio is credit already, right? Company profits.
Right.
So, I just think we should have more of that conversation. I'd love for Callan to lead us through that, because I'm just very sensitive that the committee understand what this is and go into this understanding what it does or does not do for us.
So let me just quickly go through the end over here.
Please.
So having said all of that about the strategic mandates, we will continue to bring to the board opportunities where we believe there are funds that are being raised that complement in specific niche or satellite strategies, such as re-up opportunities that we'll see later in the day. In short, fixed income is an area where we expect returns to be very low. And we believe increasing this bucket from where it is right now, 1.5% to a higher number, and by sort of unshackling the constraints that we have by going into niche funds only, will help the portfolio be more nimble and respond to where the opportunities really are. We're going to be coming back to the board. You'll be seeing we'll circulate an IPS for this, and we'll definitely welcome your comments on that. You'll see that soon.
Alan?
So, what would be useful for me at some point is if maybe we got a little cheat sheet showing the advantages of this over re-upping with PIMCO or somebody like that. One question I had was fees. How do the fees match up?
Well, we're in the process right now of working with some of the proposed managers and doing our due diligence, and we'll be bringing you these new investment ideas, the strategic mandates, over the next several months. And the fees are definitely lower. They're
Higher.
No, I'm saying
in the current.
in the strategic mandates, the fees are lower.
They're higher than PIMCO.
No, it's talking about PIMCO Disco.
For you?
Yeah.
Yeah, right. So they would be much more,
The fees would be less than we're paying PIMCO right now.
for the optimistic portfolio.
Yeah.
Yes.
And for,
But they would also have better terms and more transparency.
right.
We would, since it would be held at our master custodian, since we would have exposures available to us at will, and we would also be able to terminate the manager, we would have a much better alignment of interest. We would also structure any incentive portion of the portfolio, of the fees, to be much more rational, and so that we wouldn't be asking the managers to take on more risk just to earn the incentive fee.
And where,
No commitment fees.
right. Where's the money coming from?
It would be coming from either cash or from equities.
Cash like this. And what about the high yields that you said we're
We'll
gonna
be-
get hit on?
We'll be talking about that in the asset allocation.
Okay.
The simplest way to think of this is sort of, I don't mean to oversimplify it, it's quite complicated. Think of this as high yield plus. So your benchmark is high yield plus, so something
Okay.
like high yield plus 200, because there's more risk because it's bouncing it around. Think of it as risk that's sort of high yieldish. So it's less than equities and more than high yield, so that's why you get fees, that's why it looks like high yield plus. And it's flexible high yield is the easiest way to put it. I would as well, that's how I think about it.
On the other hand, we will allow managers in high yield, the recovery rates, if you go into Chapter 11, can be quite low because you're not as senior in the capital structure. A lot of the investments that we would have here would be either structured to be so or would be invested initially in senior securities where you have great downside protection in the event of a restructuring. In fact, in many cases, the managers would want to go to the restructuring because then they would get post-reorg equity and significant upside potential.
I mean, one of the things we're gonna do is, before we get to the actual pulling trigger on the investment, we're gonna bring a couple of the managers in and let them help explain it all to you, with examples about, we bought this, we traded out of this, and we bought this, and after a while, you'll kind of get the idea as to what they're all about.
Yeah.
Before we hire anybody, just to
Yeah,
sort of
for example,
show and tell,
I
for
mean,
lack of a better way to put it.
securitizations of CREs, I mean, what can that be? I mean, that's not paying over more than 7 or 8, right?
If it's distressed, it certainly can. But the fact is, most of those are simply outside of the opportunity set, and even if it is paying 7 or 8, as I mentioned to you before, our high yield to maturity right now is less than 7%, and 4 plus 5 is 3.5.
But with respect to those high yields, we're not worried about restructuring those now. That's a little further down the road. Yeah.
So we'll be finishing our due diligence on these managers. You'll be seeing them in the coming months from us. And it'll be also simultaneously, we'll be working with Callan on the asset allocation.
Very
Okay.
creative structure proposed. The transparency, the fees, the ability to, the liquidity is very, very well done. So I commend you all for that.
Thanks. Corpus. We have some corpus to talk about. All this can't be done without people, right? New asset classes, risk, all sorts of stuff. We gotta at some point have more damage. So, Tom David's gonna pass a few things out. We're almost not right on schedule. Almost not quite right on schedule, we're dead.
This should go real fast, right?
But we're in NYCERS time. This should go pretty straightforward. And I'll sort of push it speed-wise. So, first page, so we have,
Clarification, that the color handout is the same as what we received in the materials? Is
Yes,
that
ma'am.
the color?
in 2004, the board approved corpus funding for the investment-related activities of the Bureau of Asset Management. On page 3, this is the organizational chart when I arrived about 15 months ago. There were 37 approved corporate positions. There were 18 people sitting in seats, and there were 18 seats that were, there were 8 seats that were empty. Okay? Since that time, we looked at the organizational chart and said, well, we need to have an additional 17 positions, of which 7 have been filled and 10 are unfilled. So if you go to the next page, 5, you can see who we hired, right? We all know Simo, we know Barry, Catherine's not here, I think Amir's not here, Addie's not here, Neil's not here, and Rafik's not here. But all these are very nice, experienced people, all building out BAM, new asset classes like hedge funds, beginning to be built out. The next page, page 6, shows you postings we currently have outstanding, again, working toward the 37, that have either been filled or not filled, mostly not filled. There's 2 real estates that we've got offers out to 2 very experienced people, one for U.S. real estate and one for international real estate. We have 5 posted positions that have been posted since September, October. Head of risk, some of them work with Barry, sort of a Liz equivalent of private equity, and 3 junior people, one for private equity, one for hedge funds, one for fixed income. We decided to wait on 3 people that would report to the head of risk, a manager of financial risk, a compliance officer, and a junior compliance person. These 3 jobs currently are being done by Catherine. And that's unsustainable. if you go to the next page, going through the asset allocation, you get to, well, if you're gonna build this out, you gotta have another 10 people. The 10 people are on page 8. So for instance, we have Neil and hedge funds, but to build out a team, you need another Neil and a junior person. To get into opportunistic fixed income and build out fixed income the way we want, we need another Addy and a junior person. Building out private equity to let us perhaps do some co-investments and perhaps infrastructure, we'll need a senior person and a junior person. If we hire 2 senior people, as we're about to in real estate, we'll need a junior person. And then ultimately, when we talk about asset allocation, there's something on there called real assets and commodities. We don't have anybody to do that yet, so we have to hire a team. So that's basically 10 more people. So if you look at the summary of what I just kind of walked through, I'm going to walk you from left to right. So we started with 18 people, what I got here. We've hired 6, we've met all the 6. There's 10 open postings on the controller's website. And then there's 2, 3, and 5 new people that I'll call build-outs and asset allocation. So the band kind of grows to 44 people by the time you're done with all this. And the 44 relates to 117 billion, which is actually 118 billion as of last week. So on an organizational chart on the next page, what does that look like? It's the building out of an investment organization. So you've got me as the CIO, you've got Catherine as my left-hand person, because David Jeter is my right-hand person. You've got Martin and his team doing fixed income. Martin's also been promoted in the last 6 months to watch over the ETI program because most of that was fixed income. You've got Seema doing U.S. international equities plus building out a hedge fund team. Yvonne building out her team. Barry building out his team because, again, very understaffed for $12 billion. A real asset team to come, but you got to start somewhere. And then a risk team. Again, we have no one right now doing risk. There were 5 positions when I came. Sandra's there, but she's really compliant as opposed to risk. Then if you have all that, you probably should have a few accountants to help. So on page 12, and again, there's some specialized accountants and some accountants that we just haven't filled in that the places run too tight. So for instance, we've increased private equity. It's very, very complicated. We just haven't added a private equity accountant. So it's a little too tightly run. Hedge funds are going to need an accountant. We just need some more accountants. To process all this, we need a contract specialist, and then we need a couple of clerical support for all those people. If you look on page 13, you can see how the accountants fit into the organizational structure. This is David Jetter's kingdom. He does a great job making it all work. All the checks go out on time. So then you get to page 14, which is corpus funding. So again, let me walk you from left to right, because the first column is the number of people, the second column is the total cost of BAM, and the third column is the additional cost and existing cost to NYCERS, all of which is billed out to NYCERS quarterly. So again, starting where we were with the original team that we've hired, to date, you get 25 people, $2.3 million. You add the 6 we've hired, another $600,000. So as of now, there's 31 people, cost $2.9 million. NYCERS pays $1 million. Posted hires, which at some point we'll hire, $650,000, which gets you to the total approved corpus bodies, which is 37, $3.5 million. Cost NYCERS $1.25 million. The planned hires of 24 people on current pay scale cost $2 million. So NYCERS increase would be $706,000. So when this is all built out, which will be stretched into next fiscal year as well as probably the fiscal year after to build all this out, because this takes a lot of time, we'll get to $5.6 million in aggregate and a little less than $2 million cost to NYCERS, all of which is corpus expense. So,
Okay.
questions?
Yeah, so the chart on 10 is the investment
operation, and the chart on 13 is the administrative operation. Is that right?
Yes, it's administrative, it's the yes, that's right. It excludes a bunch of BAM accountants that are only city accountants, for lack of a better way to put it. You can explain that word better than I can, David. They excluded accountants from there?
No, I'll describe it right. It's the investment team and the administrative team.
Okay.
Hi.
Ray, Jackie, Janice.
Would there be any savings in fees that we pay to other people as a result of ramping up the organization?
First, as Dave is going to walk you through later, we've saved a bunch of fees already, just leaning on all of our money managers. Second, I'd like to think that by the time you build out private equity, you can pay your private equity consultant less. You still need them because we leverage off of the private equity consultants. But again, the more you become independently able to do things, the less you need them, the more you can renegotiate your fees with them as well. The other consultants, or the real estate consultants, I don't think we can get much less than we get right now on fees, because real estate's so complicated. We get good leverage off the council the way it's set up. Whereas in private equity, you can do more easier than in the real estate funds. And on the public side, the only fees you can get down to the managers themselves, which again, we're working on. We'll talk about that in the executive session. Detail as to the who's. So that's a long way of saying we've reduced fees already, so that in reality, this increased cost is less than fees we've already reduced. So we're spending our savings. Is the way to look at it.
Is there another half to your answer where this team is being put in place to find the best managers? And therefore, the cost of this team, should we have to hold BAM's seat to the fire in terms of increasing our returns over time with the right talent, right? And we would even argue that one pays even more than we're structurally able to pay, because great talent should really improve the risk-adjusted return profile of this one.
Yeah, I agree with that. Couldn't have said that better, I think. But we will bump into, as you just said, we're going to run into pay scale problems. It's sort of the reality of we live in New York City, we compete for talent, not directly with Wall Street because we can't pay that, but there's a clearing point that may or may not be existing BAM. So for instance, the head of risk, we've had a posting since September, October. We've seen nobody for what we're offering to pay. Now you might say, no one's paying attention. I will tell you the comp is just wrong. Just not a clearing price for comp. So there's two things you can do. You can increase your comp, or you can we advertise already. So, and we're starting to talk to someone that's very interesting about risk. I think you love this person, Roger. But they have to decide if they want to work.
We could
in the city.
outsource that if we couldn't.
You still need someone to talk to the outsourced providers. And by the way, paying is paying. Isn't it? I paid $3 million for a risk consultant.
Well,
I think I could probably build it cheaper.
Yeah, but I mean,
Al, we'll
What-
have to do some
yes.
outsourcing anyway. The systems, we shouldn't build, right?
I mean, the
Right.
issue
Both
here, to
buy.
be frank, is that there's a ceiling on the salary.
Should there be?
I mean, right, I mean, currently, there's a ceiling on the salary, is that
Oh,
what the
absolutely.
issue is? Yeah, so, I mean, at the current salary, if we can't hire the person we need, then we won't have any other alternative than to outsource it, right?
Not
Raise
necessarily.
the
One
salary.
can raise the salary, no?
No, I mean, assuming you couldn't raise the salary.
Well, why can't we?
No.
So I think that's the conversation
That's the
we
con-
really.
Okay, that's the conversation.
Yeah.
Right.
Okay.
And I think that I have been very vocal about this. The camera's on and every other board, so I won't. But I think structurally, what we can pay to attract and retain talent is our single biggest structural problem. And it directly, in my mind, relates to returns, to the long-term ability to increase benefits, not just pay the benefits that have been promised, to manage the risk so that we don't have the very sharp drawdowns. All of this links back. It's people before strategy, and we have consistently put strategy first because we couldn't get the people and we couldn't keep the people. I have commended Larry publicly for attracting this team around this table because they have come with mission and purpose in mind. I wish to keep them, but I think we have to change structurally what we're able to pay them and compensate them, because at some point, the psychic and emotional game is overwhelmed by the realities of economic need living in the city and the competition for this talent. And I'd hate to be the place where Larry brought in great talent, we trained them, and they left to take higher paying jobs somewhere else.
Just to benchmark with one simple fact for you. So if you're a new MBA and you go to JP Morgan's training program, so you're probably 28 years old, and you went to a good business school, you make $300,000. I make $224,000. And I want to hire people that have been trained and make more than that guy did. That's a problem. That's a fundamental, we got the wrong system. And, you know, we can decide we don't want to deal with it, but that's a problem.
Jackie, Janice, John?
I'm curious as to how much the proposed overall staffing plan is contingent on the ultimate outcome of the asset allocation study.
Just the only thing that you wouldn't have is the real assets, the 3 people there. The rest you need to have to run this many assets.
Regardless of how the asset allocation study,
Well,
you're confident that this
we've already
is the
allocated
right
money to hedge funds, so you got to have a hedge fund team. So that's completely additive. So Neil is additive. Neil was, so we approved hedge funds. We're gonna, right now it's currently under opportunistic equity. We're ultimately gonna have an official hedge fund allocation, just to size it right. Then you'll need a team. So once we got the first hedge fund program approved, we hired Neil, and I need to build it out because you can't do it with one person. It's complicated. And SEMA has $70 billion to worry about. You've got to have a hedge fund team working for her. So other than building out the hedge funds, Martin's been desperately overworked ever since I've met him. So you kind of just need to put the team structure back into place. I would tell you I could easily add more to this, but don't need to for now. This is all, one by one. You got to build teams out. You got to train people. One of the problems is training people is hard. It's just the city is not made to train people to be investment professionals. It's just not set up that way. So to Ranji's point, what you'd like to do is start somebody young, keep them, train them, and let them think you can stay and grow and be compensated. Because the worst thing you can do with a money manager is we fire people for this, is turn over their staff, right? And public funds are notorious for staff turnover. So the idea is have a team, different levels, senior people train junior people, it's a career path, and they stay. But they just have to, at some point, you got that clear and proper confidence.
There are models, though, for public pension funds, very few perhaps. Can you just comment on Canada for a moment?
Yeah. The way we're set up is we pay about $400 million to outside managers, and the staff of band costs $3 million. So let's say 99.25% of our money we pay out, and we pay very little to the home team. That mix is different in Canada. In Ontario teachers, a Canadian pension plan, which are comparably sized to us, they not only pay their team more, they have their team actually manage the money. So they have trade indexes. They talk about risk, and they have risk models, and they have an investment team. We have 20, they have 100. And they pay about the same in aggregate, they just have a different inside-outside mix. And their top-
Assets under management accountable?
Same, 100 billion.
They're a different
And-
legal structure though.
Well, they're set up differently.
Right. They're
not part
not
of the government.
they're not a municipal.
No, but they manage,
They're not a.
they manage public funds.
They're not a
teachers-
statutory. I mean, they're not a statutorily created municipal entity.
They're municipal, this is the Teachers Retirement System of Ontario. That's as similar as I can get to the New York City teachers. Right, they're just set up a little differently, but it's the exact same thing. CPP manages the Social Security, if you will, for a year starting in 2024, and they were given $100 billion of assets and said, manage it.
They're a contractor to the state of Ontario. They're not a.
No, they are the state of Ontario, but they're not owned by, well, they're owned by Ontario. So they're a part of the government. They're just set up with an independent board appointed by the government. Their board makeup is typically financial executives, the retired head of Bank of Nova Scotia, the retired head of this, the retired head of that. They have a financial board of executives. They hire through a search typically, an executive director. They hire the CIO. They pay their top 5 guys $1 to $3 million each. And they're sought after jobs in Canada. And they have an IRR that's higher than ours. They measure risk
They make a lot of
daily, and their returns are better.
For their participants.
They all,
Not just for
they don't, there's
themselves.
no carry, they're all government employees. They are government employees. So it's just a different model. But when you look at public pension funds, they're public pension funds. They're sort of the extreme. But again, their returns are probably 200 basis points more than ours over 10 years on $100 billion. That's a lot. And they pay about the same aggregate expense, the 400 million I mentioned, about the same. Just different. Instead of the managers, they do a lot of it themselves. So it's just a different model. And there's this Texas Teachers is sort of similarly different. It's part of, again, it's the Teachers of Texas. They're all public employees. They have a salary, they have bonuses. Their top guys make $600,000. But they have bigger teams. Different again. Ohio has something like it. Part of the government, but not quite the same. And it's the struggle of public pension funds. The number one thing, if I ask CIOs what's the problem, they say comp. You can't hire, retain, the right people.
I don't
So
think
I'll
you
come
get
back
any-
with more facts on that.
Yeah, I don't think you get any argument from this side, but we did have those guys come in and speak to us at one point before you got here, and they described their structure. It's legally, it's a hybrid that this is something Karen would have to look at. But to even get close to something like that, it might require some statutory.
It requires some bold thinking, but
Yeah.
now's the time.
Larry, another different model, maybe even closer to home. New York State Teachers Retirement System was a very long time client of mine. They actually manage virtually all of their domestic equity money internally. Now, they also manage that entirely passively. They also manage their entire fixed income portfolio internally in a more active but risk-controlled way. So their approach is a little bit different than the Canadian system, where they're not necessarily looking for alpha, but they are managing more efficiently by not using outside managers and managing that all internally.
Now, I would say somewhere along the way, when you get to this size, you're supposed to have morphed to a more professional investment
Yeah,
management
no,
approach.
I don't think you're gonna hear an argument about that from anybody.
Yes,
Take that to
and
stand
John?
on.
Larry, when we're having these discussions about asset allocations we've been having over the past few months, we've been hearing that over 90% of the return that we can expect to achieve over time is coming from asset allocation, and about 10% is coming from manager selection. And if I look at your structure on page 10, it looks like 100% of this structure is focused on 10% of where we can expect to get our returns going forward. So can you comment to us about asset allocation, just by far the overriding factor in our
Sure.
returns? Where does that reside here in your structure?
Well, recall, we haven't done asset allocation in 5 years. Okay? And then currently, the asset allocation is outsourced to count. That's where it is, we don't even have the asset allocation model, count has it. So we've outsourced asset allocation, but we do look at it now regularly, monthly. It's in the current statements, a monthly report. If you got risk moving correctly, I would tell you that part of risk is asset allocation, because you're measuring the risk in the portfolio. I need to find the right risk person, head of risk, because I would tell you that asset allocation is a function of risk. So it'll ultimately be housed there. If I can add an asset allocation person, so much the better. But I thought since we hadn't done one in 5 years, we're working on one, we'll have one done in a month. And we'll keep working on the asset allocation at the board level. Then in my critical path, if we get the asset allocation set now, I don't think we change it that much in the next 12 or 18 months to have me hire someone just to be the asset allocation person. I think we take the asset allocation and work to execute the plan.
Well, I think that's historically how we've done it, is to look at it every 5 years, but I think what we're seeing now is that we really need to be a bit more dynamic in how we think about asset allocation going forward. And Mark, were you about to?
Yeah, James, I guess I had a couple of points. I think Larry's point that I think that the outsourcing, if you will, to the individual consultants for each of the systems. What BAM has done, and each of the boards have done, is ask the consultants to play a significant role in helping to develop the asset allocation, use our models to help run the quantitative aspect and so forth, and then jointly work with BAM in coming to the recommendations that ultimately come to the board. And I think that's sort of what has worked. I think your question gets more to the issue of what are sort of the internal asset allocation tools, not necessarily, tools is the wrong term, but what's the staffing for asset allocation at BAM now? I think the way we've worked with BAM, and I think the other consultants have done this also, is I think internally, as we've viewed it, the senior professionals, so Martin, Seema, Larry, I think John Merchantberg has been part of this also. I don't know that it's been an official asset allocation committee, but I think sort of the senior people at BAM have been very involved and helping to lead the discussions along with the consultants in ultimately getting to what the consensus will be in terms of presenting. And so I agree with you. I don't think there is a sort of an asset allocation type of person, as you might think of it from a quantitative standpoint, in here. Whether there needs to be or not, I think could be argued both ways, but I do think that sort of the way it's staffed internally now is sort of from the senior asset class professionals in helping to work with the individual consultants.
I just think to conclude that I would like to see us take more of a lead role at BAM with regard to asset allocation, and not just look at it at once every 5 years. I think it needs to be, and we've seen that based on the downdrafts we've experienced, needs to be more of an active role. And Larry, if you're saying to us that your feeling is that this risk person is going to be both risk and asset allocation.
Yeah, that's their job is going to be measure the risk on a regular basis, do the sensitivity analysis, do the testing of it, make sure we don't get surprised by risk, and then help to turn it if we see something coming our way.
And strategic thinking in terms of new asset classes that we need to be giving us direction on those.
Again, the biggest problem that we've got is we can decide whatever we want, we can't get it done. My frustration is I can tell you all sorts of good stuff to do. I can't get it done. Time. Time and staff. Lack of staff. Time. So if you ask Martin how many projects he's got, he's still working on the ones I gave him last year. Not that he's not working his butt off. just needed more people, so we got added, so now they're all busy. So I mean, it's, we're 100%.
But again, I'm talking about 90% of our return a year.
I think we'll get the asset allocation right next month, but then to implement that, it'll take us a couple of years. And it's not static, the problem is it's not static. So we will keep probing the asset allocation while we're implementing this one. So I think asset allocation is a very ongoing board level discussion while we're measuring it, as long as I get a risk person and some tools to measure it. Because the other thing, once I get a risk person, then we're going to have to spend some money getting the tools, right? $1 million plus, minus. But just so we're all clear, we're trying to get risk tools from some of our money managers for free. So far, we don't have that. But SEMA might have it. Yeah. Right?
I have what? Sorry.
Risk tools for free?
Oh, yes, actually, I'm working on that.
Right.
As part of our conversations with different hedge fund administrators, because we need to hire one. What a hedge fund administrator does, in large part, is fill out your subscription documents for various funds you might want to invest in. They will help price the value of your hedge funds as you make investments. They do some things like that. And as part of these conversations, I've said to them, by the way, you have a risk team, right? And we've met the risk team. You have a risk system, right? And we look at the risk package, and I say, you know, to be competitive for this bid, it'd be really great if you could talk to us about helping us manage and measure risk across our entire portfolio. What would that look like? How much would that cost? Because if it's too high, it's not really going to count. But if it's in our ballpark and in our zone, then we should talk, because that'll add more to your proposal for trying to be our hedge fund administrator. So we're getting some good results back. We'll be able to hopefully share some good news with you as we move down the line with trying to hire one of these hedge fund administrators. But it's very much a part of the conversation.
And just one other point that I know Ranji's brought up in the other board, so why not bring it up here as well, is with regard to separating compliance, which is typically an operational risk, versus investment risk. And in this particular org chart, they both seem to be under investment risk.
Right.
I just wanted to comment that that's a bit atypical. Both, and Mark, you're nodding your head in agreement. Typically, investment risk, the things that Seema is talking about, do reside in the asset side of the shop, but compliance risk is typically legal and compliance more in operational.
Correct. I would agree.
Yes.
The last list I looked at, in fact, the person I interviewed yesterday said there's 50 risks that the head of risk should worry about. So I view risk as any risk that we have, I want someone to think about. And all that becomes the head of risk. Anything that could hurt our portfolio, someone should think about, and that's the head of risk. Now, there's quantitative risk, there's modeling, there's the quant. That person might be the quant, it might be the head of risk, but you still need to worry about these other risks, and BAM is not set up to worry about those risks. So I want to have risk in one place. And as businesses I've been associated with, when you split risk, you lose something. Because they go like this, I wasn't worrying about that risk. And that's how you have accidents. So I want someone who is the risk person. And again, if it turns out that the person that we hire for the head of risk is really uncomfortable with what I'll call legal risk, fine. Then we can pull it apart and say, all right, it's legal risk. But as soon as you pull the risk out, you've just opened up a crack. So we'll know when we see it. And I'd be happy to share my list of 50 risks with you, which I'm sure you know, but there's just a lot of risks that are not covered currently.
Agreed.
Right?
Did you?
I was just wondering if that's part of the problem with nobody responding to the job, because investment people who are great modelers, who really understand the tools that your hedge fund administrator would have, or a BlackRock or a Callan, is just not going to want a job where they are trying to do manager trade compliance and back office risk. and that might be,
I'd be so happy if someone came and said, I'd like the job except for this. I'd say, great, I'll take that away from you. We haven't had that problem yet.
sounds like you go one. And this has been, I'm very nervous as we have this conversation that we're having before between hedge funds and distressed. We're taking on a lot of risks that we've never had in the system before, and they're actually highly correlated to what we already have. That conversation just, I really must wonder if we shouldn't do it till we have the right risk people. If you know what we're getting into, if you can't measure it, understand it. Back to if you don't understand it, don't do it. And the other thing I would say is my real worry with outsourcing thing is it doesn't get built into the BAM culture. And that is a huge element. You know, I love when Seema talks about we should not look at this fund of funds manager because risk is not part of the culture. Where is it steeped in? Where can the junior analyst sit there and show me how they think about risk within BAM? And I know that's your goal, Larry, so I know we're completely aligned, but
Right.
it's very troubling as a trustee to think about even more and more complicated asset classes which have these overlapping risks that we don't measure in our long-only portfolios without any hair on it. So one more time, we urge you to really focus on this job, and you know, if you need 2 more people, come back to us on risk. I think our team feels very, very clear that even the proposed hires leaves us very exposed on risk.
Risk is gonna be comp. That's where it's gonna live and die, and I'll be back to you with hopefully a person and a comp. And then we'll all see what we want to do about that.
Good luck.
Good luck. Hopefully I have the person with the comp,
Oh,
right?
don't jinx it.
So I need the board to approve this, I think. Where's that? Is that what I need then?
Have the other boards that when we did, that's what we did, so I took the liberty of heading down a motion which the board can feel free to amend. What I would recommend is that the board authorize an increase of 24 corpus funded positions for the Controller's Bureau of Asset Management for a total of 61 authorized positions. The board further authorizes an increase for NYCERS of $706,118 to fund the additional positions, bringing NYCERS' total share of the corpus funded positions to $1,954,468. I'll type it and send it to you. You shouldn't have to read my handwriting. So, I don't know if someone wants to make
Do we
a
have a
motion.
motion? Second? All in favor?
And before, okay. I just have one question on that. The numbers you're giving us are estimates, right?
Yes, there are estimates that can be found on page
414.
of the presentation.
Okay. And they'll only take effect once the positions are filled.
Yeah, pay as you go.
Right, yeah.
And is that just salary, or is it salary plus?
Salary only.
And to the extent that that changes, then
We'll be back.
We'll be back.
we'll be back.
Right. Okay,
Okay,
so that ends the public session.
we get a
Agenda.
motion to move out of public session into executive session? Second?
Second.
All in favor?